Hit it.
It's Friday, December 1st, 2023, episode 227. I'm Patrick 𝗪𝗓.
And I'm Kev and Jonathan. This week, we have the pleasure of welcoming Jonathan Lansky, author of the No Straight Lines investment letter. Jonathan is an old school stock picker, and he shares a bunch of different names that he likes, talks about his process, and why investing is the most humbling of pursuits. Then, with the markets doing some crazy stuff, Patrick draws some lines on charts and tries to make sense of the madness in this week's Talking Charts segment.
And then we end with crayons with Kev and no stupid question. And folks, we might even drink some beers along the way. Lena, hop on. What beer am I drinking this week?
This week, we are drinking 𝗬𝗓𝗏 𝗪𝗘𝗓𝗜𝗓𝗏. I can't say the rest in French. So,
well, you know, Kev, you should be drinking this because you brought it from the East Coast and you're being soft.
Yeah, I am. I'm being soft. It's Patrick makes us record these at lunchtime on Friday. So, unfortunately, I don't drink during trading hours.
Amateur.
Hard and fast rule.
I had to Google Translate the description of the beer because I can't say anything in French. It says blonde thirst quencher beer, German inspired, malty, lemony, and with a good taste of honey.
What do you think, Patrick?
Oh, it's actually I do taste the honey in there. It's odd. It's actually a good beer. It's a good beer.
Okay, before we go any further, Patrick, you have an announcement you want to make?
Yeah, I'm doing a special webinar. I believe there's an extraordinary opportunity to protect your portfolio in this market volatility. It's rarely ever been cheaper to ensure the downside risk of your portfolio. So in light of this, where we are in this economic cycle, the topic deserves a much deeper explanation than a quick mention on this podcast. So that's why I'm hosting a special free webinar that go extensively into detail why I think this opportunity that our listeners must understand. I'm hosting on Monday, December 4th at 1 p.m. Eastern time. You can register at bigpicturetrading.com. Now, Kev, give us some side effects.
Well, before we do that, so it's completely free, Patrick?
Completely free.
You go to the website, and I am upset. Lena and I pushed really hard for the free toaster. So there's no free toaster.
One person gets a free toaster.
But it is free. So go check out Patrick's webinar on Friday, or on Monday, December 4th. All right. Nothing in this podcast should be viewed as investment advice. Listeners should consult an investment professional before making any decisions regarding topics mentioned in the show. Side effects of too much huddle may include 𝗪𝗘𝗕𝗜𝗔𝗥, inverse Brewski beta, and the Elon eruptions.
Ooh. You don't ever want to suffer from those. All right, let's get to our guest.
It's our great pleasure to welcome to the show Jonathan Lansky. Jonathan is the author of the No Straight Lines investment letter. He's a former institutional equity trader and prop trader from Toronto, and I'm just getting to know him here a little bit here. Jonathan, it's a pleasure to have you on the show.
Kev, thank you very much for having me. Really excited to be here.
Although we've never kind of crossed paths in real life, it seems like we were just laughing about how many friends we have in common. We're about the same vintage, about the same kind of era when we grew up on Bay Street. But I'd love to hear your story about how you got into the markets. Was this something you always wanted to do?
So I alluded to this on, short answer is it wasn't something I was thinking about in my teens. I would argue actually not even as I was going through, I did biz school at WLU in Waterloo.
Okay.
And you know, I specialized actually in accounting. I did my CA way back in the day.
Right.
And when I finished biz school, the only thing I knew I wanted to do, and I'm being totally honest here, is I wanted to be a ski bum. And I moved to Fernie.
Oh, you did?
Yeah, I lived in Fernie for a year after I graduated. Well, actually, after I did my CA, I wanted to actually get my letters before I left, so I had something to fall back on.
Okay.
And yeah, so I lived in Fernie before it became sort of busier. This was when it was, I mean, if you go to Fernie today, you might not think it's busy, but it was quite backwoodsy back then. This is mid 90s.
Because they made that hill from nothing, right? Like it was this backwoodsy little place.
Yeah, it was, there was no high speed lifts. The main lift, in fact, was a T-bar. That'll tell you all you need to know about it. But it was fantastic. One of those things, only in hindsight do you look back and go, good Lord, I'm really happy I did that, you know? I went basically straight from there. So I'm getting to my answer here. From there, as I was skiing and, kind of getting my fix, I sort of felt like it's a classic feeling. You feel like you're falling behind your classmates, right? All your friends are doing this and doing that. And here I am skiing POW every day, which now seems like a really smart decision. But back then I was nervous about it. So I had a friend who, we all have friends who say, hey, if you ever need a job, give me a call and I'll help you out. And like 99.9% do not return your call when you call them.
Right.
Well, I had a friend who did. And anyways, I landed a gig at CIBC doing investment banking, which unfortunately lasted about 3 minutes, but it taught me a lot because I realized I did not want to be an investment banker. I was there for 18 months. I'm exaggerating a little bit, but I got the bug. That's really where I got the bug for. And to give you an idea of the vintage, you guys will laugh at this. I was an investment banking analyst. And if you know anything about that job, they're the ones who do all the spreadsheets and look up everything, all the information, look at all the filings, all that stuff. When I started, only half the firm had internet access.
and the other
you
half
can't make that up, Kev. That's a true story.
And they didn't know how to use Excel.
I swear, Excel was in its, not in its infancy. Like there was spreadsheets modeling around that you could sort of copy and paste and, figure your way around. But like 𝗕𝗓 was only online, had only just gone online, just to put it in context.
Right. That's unbelievable. So you get there, you figure out that investment banking is not for you. Yeah. How do you make the transition to being a sell-side institution?
So, and a classic sort of, things that happen that are not planned. So a friend of mine that I grew up with was a equity trader at First Marathon, and he called me. It's not like I didn't talk to him regularly, but I hadn't talked to him in a few months. And he calls me out of the blue and says, sales guy just quit, junior sales guy. I think you'd be perfect for the job. Here's the boss's number. Give him a call. And so literally,
what year is this?
This is 1990. This is late 97.
Okay.
So I pick up the phone and call Rob 𝗦𝗔𝗔, who was running the desk. And I didn't know anything about him. It shows you how informed I was. And anyways, long story short, he called me back right away, which impressed me out of the gate. And I was fortunate enough to land the job. And that sort of set me on my way to equity sales. And and then I did that for basically a decade. I finished at CIBC. I ran the desk there for my last couple of years, which was not what I wanted to do. That's always what happens, though. If you end up doing
if you're too good at your job.
I honestly, all I wanted to do was, sell stocks. I didn't want to manage people, and who would really? And anyways, it led to, quite honestly, mental burnout, and we agreed to part ways at the end of 2006. And that's when I started working with Steve on the prop desk at Dundee in March of 2007. And I was there for 12 years.
All right. So let's just rewind. You're sitting there, you get this job at First Marathon. It's late 90s, the .com. It's actually a great shop. It's an old Mike Weckerly shop. Now he's long gone, but you're at this really kind of dynamic shop. Just tell us a little bit about that experience, what it was like, because I think, after also that was the same time I was at RBC. So I was competing against you guys, but it was really just a fabulous time to be young and to be in the markets. And I'd love to hear your take about as you reflect upon that period.
Sure. I mean, first and foremost, only in retrospect do I realize how much talent I was fortunate enough to work with. At the time, wet behind the ears and not aware of, I was aware that like my boss had a lot of stick, like the folks he was getting on the phone. For example, he would get like Michael Lee Chin on the phone and trade 10 million shares of Loblaws at the flip of a hat kind of thing. And I was blown away by that. But I think the real thing was that First Marathon was an eat what you kill culture. As a salesperson, I was paid, a percentage of my commissions. So I really sort of understood early on that it's up to me to figure out a way to, make money for my clients and make money for myself. As far as the environment it was, I suppose, like other things, the morning meeting was sometimes like hand-to-hand combat in terms of, trying to get ideas across. Salespeople would be yelling at the analysts would be yelling back. The traders are caught in the middle. It was eye-opening, but awesome. Like, to your point, it was amazing.
When you think back to that .com bubble,
yes.
Do you think that it's similar to what we're experiencing now?
I don't, because, back then, I think those businesses were priced to air. We can quibble about, the leaders in the marketplace being overvalued. That's a discussion to be had, of course, but the actual fundamentals, the free cash flow, the balance sheets, the size of the businesses, the sheer size of the businesses, like, no doubt, as you know, Kev, there's always stuff that pops up that is priced to air, right? But right. I feel like the breadth certainly is reminiscent, given what happened with 𝗦𝗘𝗕𝗜𝗓 up here, of course.
Right.
But Canada, unfortunately, we have a history of the champion becoming not so great shortly after they become the champion.
Yeah, it's kind of funny how many companies, when they beat Royal Bank to be in the number one company, they end up in disgrace. What, it was a Potash, 𝗦𝗘𝗕𝗜𝗓 Potash, like the list. Was it Concordia?
There's the old
or Valiant?
It's called
Valiant.
Bosch Health now, but that one,
Valiant,
Spotify, or not Spotify, Shopify got up there, right? Like, I'm
convinced Royal Bank does something to them once they beat them to the spot.
It feels like one of those, those magazine cover curses, right?
Yes.
That's what it feels like, for sure.
But you got a great point, though, that the pricing of the companies back in the 90s, late 90s, early 2000 was much more speculative. Whereas now, when you look at the Mag 7, these companies are actually earning money. Like it's
oh yeah.
Like they're
well, here's an example. I'll give you a funny story. I hope it's funny. I think it's funny of sort of back then. So late 99, maybe early 2000. This is before the March peak. Okay. We went out to, we did a Vancouver technology tour, and I'm out there and we visit Sierra Wireless, the offices of Sierra Wireless. Okay. And we go, and interestingly enough, I can't remember who else we saw. The printing company, it's Creo Systems. Creo Systems was on that tour, which ended up being taken out. But anyways, Sierra Wireless, this massive office, if you can imagine, like acres and acres of empty office space, and every single office had a Herman Miller $2,500 office chair. Okay. And so I had two conclusions, right? And the first conclusion was, wow, they have money to burn, right? Because there's all these, like, they're going to grow like crazy, but they've already got the office chairs before the people are sitting in them. That's incredible. And then the second thing I thought was, there's got to be a glut of office furniture, right? And funny enough, Lansky covered all the office furniture stocks. And I called him up and told him, and he's like, "Are you serious?" I was like, "Yeah." And I took a picture. I sent it back to him. He couldn't believe it. So to your point about like price to air, they were anticipating this growth was never going to end. But not just that, they were spending the money in advance of that growth actually transpiring. That's what I think was so different.
Yeah, no, you're absolutely right. And there was all like no revenue almost, and
literally no revenue. Yeah.
And if you actually try to issue stock and do the prudent thing without spending it, you actually got punished because you weren't going to own
100%.
Yeah.
And I would make another observation, just to sort of, man on the street sort of view. I remember at the gym every night, every person in the gym was talking about how much money they'd made trading stocks that day.
Right.
I mean, I should have known. I wasn't smart enough to figure out this has got to be a top. Like, I remember specifically a guy interrupted me because I was telling him I had sold stock of, I'd owned a little bit of Descartes Systems because, like, I'm a Waterloo guy. It was a Waterloo story. And anyways, I'd made money. The stock had gone up $20 in like 3 days, and I sold it. and an analyst who worked at GMP at the time basically yelled at me that I was a fool for selling it. I mean, it literally should have been a perfect tile, but I didn't understand. I didn't figure it out. Right. I wasn't that smart. So.
Okay, so let's fast forward to the prop trading group. You go to a Dundee. How does that, like, you're burnt out? You decided that the sell side's enough, and you can go to the buy side. Although I guess it's not really a traditional buy side. Like, it's not. It's kind of. And why don't you explain a little bit about what it was, what you did there?
So basically, the attraction was working with Steve. Quite honestly. So, I was burnt out and was looking for what we're all looking for. We all want to work with people who we can learn from, who possess a skill set that we would like to, attempt to acquire, and who I knew was a good person and I got along with very well because we had worked for 3 years. Put it this way, Steve, when I first met Steve, when you're the junior salesperson, none of the analysts want to talk to you. Why? Because you can't make them any money, right? And Steve was the first guy to open up his office. He was always willing to answer questions. He would call my clients, even though he knew there was very little chance that those clients were going to transact. And that sticks with you when you're older, right?
Right.
And so Dundee was an opportunity to sit side by side with Steve. Dundee provided a pool of their capital. And the basic idea was we would manage our own money it wasn't commingled, but alongside this prop money. And the advantage for us was it gave us access to, street-wide research flow, whilst still being able to, look after our own portfolios. Right, prop obviously gets first priority, much like if you're managing, anybody's third-party money. Yeah. But that was the basic gist of it.
And so what were you guys doing? Just picking stocks, long, short? What was the kind of gist of it?
It was just picking stocks. Even when I left First Marathon, I should have clarified that. I used to run an annual stock picking contest as a salesperson, and you were allowed one long and one short, and you had to hold it for a year, which, these days probably sounds ridiculous, but that was what we did. And Steve won that contest a couple years, and that's sort of how we stayed in touch and sort of how we identified each other as stock junkies. So we were keen to work together, because it sounds funny, Kev, but this, Canada is not an equity market or an equity culture, right? Like in the US, there's lots and lots and lots of billionaires made through the equity markets or through the capital markets, call it debt or equity, right?
Right.
Canada, not so much.
Yeah, no, we our level of wealth as well is much less.
Oh gosh, yes.
Yeah, like I remember
if you want to feel like an odd lotter, go down to Palm Beach, right?
Yeah. Well, I remember when one of my good friends told me he's an investment banker, and he's subsequently gone off to his own shop, and he told me, he said, like, if you want to sell a company that's like $1 billion, you can in Canada you can phone up 10 people that might be able to buy that. He says you can go to Alabama and phone 10 people that might be able to buy that.
It's truly, I mean, pick an industry or I was a bit of a golf nut when I was younger, and that was what always struck me. You could pick a golf club anywhere in America and go, and there's 20 people there that are shooting in the mid 60s that can't make any money on tour, but they look like they're tour players. That's sort of the analogy,
Right. That is a good analogy. I like that. Yeah. Okay. So you guys are picking stocks, and how does your style change? What do you guys learn from that, and how long do you do that?
So I'll answer the last question first. We did it for 12 years. Okay. We started in 2007, and you may remember something that happened shortly after that.
Yeah.
And so that was interesting. We learned, maybe if you'll permit me, I can tell another sort of funny
go ahead.
Story.
Yeah.
So it is October of 2008, and I believe Lehman had just gone down, and Steve and I, don't ask me why. Okay. Obviously in hindsight, it was insane, but we had decided that we were going to buy a little bit of Morgan Stanley. Okay. And if you recall, again, this is looking back from, The Big Short and other historical references, but Hitachi, I think it's Hitachi, I can't remember. It's one of the big, they were the big backer of, right? They were the big backer of Morgan Stanley. We did not know that at that time, it wasn't clear whether Hitachi was going to honor their commitment. And so Morgan Stanley was trading at $8. Okay. I was down to my last nickels, but I was like, this is a good risk reward. It's $8. How much lower can it go? Famous last words. Right. And so it's $8, and literally 5 minutes later, it's $4. Not making that up. Okay. Right. And Steve and I are looking across from each other going, we obviously don't know what we're doing. Right. Like there's something else is going on here. Long story short, the next day, the stock flattens out back to 8. And honestly, within a week, I think it was 25. It was crazy. Like it was $25. Yeah. I didn't hang on to it. What I learned at that point was when things are scary, this is Steve's expression. I'm borrowing it from him. Stocks are just pieces of paper, right? They're not businesses. They're not representing a fundamental value. That's not how the market treats it. It's washout, right? That doesn't mean you don't hold it. It just, you got to recognize what's up, right?
When in those moments of fear. Actually, I'm going to just tell you a quick story because it reminds me of something I had as well in the GFC. I remember when Citibank had these preferreds, and something came out, and it was pretty clear that the government was going to back the preferred. And so I did all this work, and I was like, let's just say the preferred was trading at $5. And I figured out that it wasn't going to be money good. Like it wasn't going to be back to 25, but I figured it should be a double. It should be 10 or something.
Yeah.
And thing, opened at 4 or something, like, because it was this big announcement people were confused about. And I bought way too much. Way too much. And next thing I know, the thing's like 1. Oh, and I'm like, holy shit. Like I completely I just like you, I was like, I must be an idiot. Like I must not understand this. And I remember we had this programmer kid beside me, and he says, "Are you going to sell?" And I go, "No, I'm like, it's worth $10. It's going to be $10." And he wanders in at $1 and buys himself a whole whack. And sure enough, within 2 days, it was $10. But to your point about the fear, when in those truly scary moments, people don't understand, or a lot of times people forget how distorted from fundamental value assets can become.
And I think, to continue that point, like the other sort of, GFC takeaway for me, I was sitting with the person who I at the time considered and still consider to be the best stock picker I've ever known by a country mile. And he was nervous and he wasn't sure. And it made me feel, in a perverse way, better about myself.
Yeah.
Because here's somebody who has made money in every kind of market, in all different kinds of stocks. And, it causes you to blink. Right. And so, and then, sort of to continue, like in terms of other things, I think, not to be dogmatic, Steve's approach. Here's a great example. Like you could call him up and pitch him a story, and he might literally say, that's to use a bad word that my kids think is a bad word. That's stupid. Right. And okay. And I got told that a lot, needless to say, over 12 years. But what I admired about his investing approach was he could turn around a week later and for whatever reason, the winds have changed. He sees something different. Tell me again about that story. Right?
The stupid one.
The stupid one, right? Or even better, actually, I should make it even better. He had purchased it and then, hey, have you heard about this one?
Yeah.
And I say that with all respect, obviously. He's a great guy and we still talk. I think he's a really impressive, interesting guy to talk to.
Okay. Yeah. So now you just trade your own account, write this letter.
Yes.
let's talk a little bit about markets. What do you see? What are you thinking about? Like, what's at the top of your mind in terms of when you're looking at this, where we are in the cycle and what you worry about here?
So, I guess I'm most worried so I am generally optimistic. Okay. I guess I should start with that.
Well, you're an equity guy. The equity guys are
I'm an equity guy. I'm a sales guy. I've never shorted anything. So you can right away accuse me of being on that camp. That's fine. I will take that. It's true, right? The truth hurts.
Okay.
So I worry that I'm missing something. Obviously the way 23 played out is not the way most people were thinking it was going to play out at the beginning of the year.
Right.
And so, you and I cite a lot of the same sort of indicators that suggest, we could be on the precipice of a recession. It doesn't feel like a recession to me. And so I worry that I'm wrong with that, but I'm not extended in names that I believe are, I'm more of a bottoms up guy, right? Obviously you have to pay attention to the indexes. But I feel like I've got myself protected through, the specific, drivers of the stocks that I own. But of course, if the market goes, pear-shaped, it doesn't matter.
So will you ever cut back on your exposure because of macro concerns?
Yes, absolutely. Okay. Yes.
So
I was, for example, mid-year, maybe April or March. I won't say I got it before I obviously didn't see the retail banking
the regional
crisis,
but
I had a regional banking crisis. I didn't see that, but I was sitting in a reasonable, like historically, I haven't run more than 5% cash, and I was sitting in, 40% cash.
Okay, so that's about as bearish as you get.
That's probably as bearish as I would get. Yes.
Okay.
Yeah.
And not only that, you're also picking stocks that you think do better in a recession.
Yeah. There's obviously, it's only proven after the fact, which is probably the thing that drives people most crazy about the markets. But, you have to make a prediction. So yes.
Right. Well, the other thing is, I think that a lot of people seem to think that there's, all stocks go down in a bear market in a recession. Yeah. That's not actually the case.
No. I think what's, if I could be so glib as to say what's missing in the narrative, there's obviously tremendous amount of focus on the Mag 7 and the concentration of performance. And, the breadth is whatever it is, 25% of stocks are outperforming instead of 50% traditionally in the S&P, something like that. Right. And so, but, me being the optimist, I kind of look at the other 493 and say, not that it's exclusive to the S&P 500, but okay, let's look under the covers here. How are these these companies trading on a valuation basis? And kind of, what are you hearing from the companies themselves? Like, it's amazing when you listen to a conference call, even on, well-researched stocks. I find it fascinating how, and maybe it's because I'm ignorant, I don't know, but quite often the tone is a lot different than what you get from the analyst report.
Oh, okay. So now, do you ever use that as like an input in your research decision? Your investment decision?
I would say that what I use it for is it's part of the mosaic, right? And so, if I'm looking at a new name, like I initiated a position last week in Dick's Sporting Goods.
Okay.
And I've been looking at the stock since last March. I think they puked out in March. They had an inventory, way too much apparel, and the stock got smoked. And it's historically been it's an amazing, if you've ever been to a Dick's Sporting Goods store, you know what I mean. They're unbelievable stores. And so the financial metrics are all incredibly impressive. My point is, I went back and listened to like 5 conference calls, and maybe I should have listened to 10, I don't know, but I listened to 5 to get an idea of the cadence and sort of the, what's the style, and, is the CEO typically more conservative or more aggressive, like all those little tells.
Right.
And then most importantly, the Q&A, right? Because it's amazing how much the stock price, of course, influences the tone.
Right.
We're emotional creatures, right? We
Yeah.
follow our noses. And so, I guess my point is, like, on the most recent, and I'm not pitching dicks here, it's just a data point. Okay.
Yep.
They made a comment, the CFO made a comment on the most recent conference call that they saw a dislocation in the stock price, and they bought back $400 million worth of stock in the quarter. And I thought, man, that is such a powerful statement. And one analyst put that in their note, one. And
Wow.
for me, I think that's like, and that's what's so interesting about investing, of course, is that we all have our things that stand out, and you'd have 100 people listen to that conference call, and each one of them would have a unique mosaic of what they thought was important and not.
Right.
But that to me was the very powerful statement about their conviction in their business model, in where they were going, and the numbers. Anyways, that
I think Doug Cass always says, "Watch what they do, not what they say." Okay, so let's go through this though, because I'd love to know when you started buying this, like what triggered you. I just like to understand the process. And since you mentioned this one, so it's trading around in the summer. It's at $145, and there's a big gap down. And I'm assuming that's an earnings miss or something of that nature.
Yes. Yep.
Okay,
Yep.
So there's a big earnings miss. It gaps down to 115, and then it trades down to 100 basically in September and October. Now in the last kind of month, it's rallied up from 100 to 140. We're almost back to the point where it gapped down. At what point were you interested? Was it as soon as it gapped down? And how long did it take you to research? I'd just love to kind of understand your process.
Yeah. So I would love to tell you that I initiated my purchase at 100. Okay. But
listen, I got to tell you the line that I love. Harley Bassman says, "I've never bought the bottom except that one time when I went to sell it and I hit the buy button by accident."
Well, I will say, like, one of the things that is most appreciated in your writing is the humility, because I find, in general, it's sorely lacking. And what I read into that is either those people are bold-faced liars or they aren't actually investing. Because if you spend any time, to use an overused term, in the trenches, you're getting force-fed heaps of humble pie regularly. It's just the way it is.
I like that, force-fed heaps of humble pie. I like that.
Well, it's a good image, right? Because you know exactly what it feels like, and so anyways, on the DKS, it obviously tweaked more interest at 100. But I wanted to, here's the other thing for me, individual investor in Kelowna, and I don't have I have okay flow data. Like I have some US friends, sales and trading folks, who are still, very important parts of their own individual firms. So I get decent intelligence,
right?
But it's not the best. And so I'm always a little more cautious. My Canadian connections are stronger. It's a smaller market, obviously, et cetera, et cetera.
And these are connections, meaning like if Fidelity's selling, you want to know that he's done before you're starting to walk in there.
Or at least have a clue. Yeah. Right. I have a friend who's a sales trader, been down there trading in the US for 30 plus years, and was a big shot during the tech bubble. Like he worked at all the big name technology shops you would have thought you would have heard of back then. He was the head trader. So he still trades. And so he's really my go-to guy for, desk intelligence.
Right.
Outside of the weekly stuff that you and I both read that, Goldman and whoever else sends out on prime book data and all that stuff. Right.
But will you wait to buy it if there's a big seller?
I'm an odd lotter, so I don't,
No, you're not worried about affecting it, but meaning that you wait for some sort of, like, if
I don't. I don't know. I don't want to over dramatize.
Okay.
No, I don't. I just, what I really wait for is I need to do enough work. And what does work mean? It mainly means for me, reading a bunch of research reports, like I said, listening to calls, and then quite honestly, sort of the Warren Buffett thing. My experiences with these stores, in this case, where every time I went there, I was just blown away. And so you sort of sit back and go, okay, well, how broken is this business or not? And then, the other thing to finish the thought here. So in 2019, the EBIT margins for Dick's were 5%, 5 and a bit. Okay. Their most recent Q3. And so to answer your question, I bought the stock after Q3.
Okay.
So Q3 numbers came out and the EBIT margin was, 10.7%, something like that. And I don't care about, 22, because everybody had more money than they knew what to do with. And so margin analysis from that period, you kind of throw out.
Okay.
But effectively, this company has structurally doubled their margins. Okay. And the stock is not trading at that, like indicative of that. It's trading at now with its move, it's trading basically at 10 times earnings. Okay.
Yeah.
The return on capital of this business has averaged 22%. Again, if you listen to the conference calls, these are, again, call this a soft point. Okay. But you'll appreciate it. If you've listened to thousands of investor pitches like I have, you get a pretty good idea quickly whether the management team has their arms around the business or not. Right. And their ability to answer every question quickly and also enforce how their strategy, improves whatever metric may be being talked about. That's the sense you get from the DKS team. And then it bears out in sort of what they're doing. And so I kind of looked at it and I believe like a lot of these consumer stocks, as are being pushed aside on the view that, consumer spending is going to roll over, which maybe it is. But here's the thing, model out a scenario where you're not anticipating same store sales growth of, make up a number, 5%, but you're only modeling like 1% or even flat. What does the earnings picture look like?
And when you did that, it was something you could still feel comfortable buying.
Well, when you do that, I mean, the analysts, to their credit, at least, I suppose, they're not anticipating, robust sales growth. And the earnings number comes out to, 13 and a bit. Okay. But that doesn't even assume really any improvement in EBIT. It basically means EBIT margins are flat. Okay. And you could argue that's aggressive or conservative, but I feel like it's prudent at the very least. And so I'm okay putting some money to work at that valuation.
So now when you have something, you're in the fortunate spot where you're actually up money, what would be your point where you'd be selling this?
I don't have a good answer for you to that, to be honest with you. I don't have because, we're going to get to those questions at the end, but I wish investing was purely science and I could give you a calculation that made sense. And that's where I'm exiting.
Right.
I think that at this stage, the stock is, I'm not going to say it's in the penalty box. To your point, it's kind of back where it was.
Yeah.
But I would argue with a lot more information and what's the big thing with retailers? It's their inventories, right? And, they were extremely confident about how they had positioned their inventory. It's down 2% year over year. But more importantly, it's in categories that people want. And maybe the most important thing is the way their stores are merchandised now. All of the suppliers want to be in their stores. So they're kind of in that catbird seat where they get to pick the best of the best.
Right.
And as you know, if you've got that, you by definition attract your higher than average share of traffic.
Got it. So now is this, how many names will you own like, is it 10, 20?
I'm at right now I'm at 20, which
Okay.
is kind of at the high end, I would say. So part of that I suppose you shouldn't be surprised. I mean, the market is I don't want to say it's fully valued. It's just, you got to be careful. I don't want to make too focused a bet and have my head handed to me. I've been fortunate. The names have done, I think on average, the names are up 14.5%. So not bad.
Now, one of the things is we talked about the Mag 7 and then the other 493 or even all the rest of them. Yes. By kind of extension, it means that the other stuff is cheap.
Correct.
Right. Like there's, I have a good friend that he's big time money manager, and he's been arguing for a while now. He's like, a lot of these companies are priced for recession.
Yes.
And so do you have anything that sticks out to you as like, oh no, this company, even if we get a recession, it's already priced into the market?
So, one of the areas I don't know if your friend agrees with this, but financials, right?
Yeah. Oh, no, he's long those. He loves them.
And so by definition, first of all, this by accounting convention, putting on my CA hat for a second, they are forced to take provisions based on their scenario. And if you listen to all their conference calls, their scenario anticipates a shallow recession in the US. And so my simple mind, I believe that, and, frankly, I've been wrong. Okay. So I called this for Q3 when we started to see pockets of, the new issue market come back to life. Right. And so, Birkenstock and Value Savers Village and a few other names came out, Instacart. Right. The problem is none of them have done particularly well post issue, which is not helpful for other deals to come.
Yeah.
Having said all that, I decided to get long some Goldman Sachs because it was trading at book value, actually trading below book value. If you look at the year to date capital markets numbers, they're abysmal, of course. But at some point, it feels like the switch will flip. What is that point? Well, one of the keys, I'm not speaking anything new to you here, Kev, is that people have to be convinced that rates aren't going up anymore. And so, without being declarative here, it does appear that rates have peaked. And so at a minimum, that leads to a lot more conversations happening around, maybe an IPO, some sort of M&A, even just getting financing together to do M&A, right? And so that's I've picked Goldman Sachs. You could. I also own a little Bank of America, which hasn't been great, and you know why. But
now, can I ask you about Goldman Sachs? Because to some extent, isn't it a self-inflicted wound by the CEO? Like he was too busy DJing.
Yes, I would say Mr. Solomon has had some well-documented, and there was was it in the New Yorker about how everybody hated him?
Oh yeah.
One of the magazines was nobody wants to get that kind of press, obviously, right. but the machine is the machine. I mean, they still end up, top left on more often than not on the most important financings that happen. And so I just figure it's a cheap call option on a rebound in capital markets.
I can't say I disagree. I actually think it's really smart. And there's one thing I think that Buffett recently asked for. How like they have to do the 13 Ds or 13 Fs, they have to disclose what they're buying. But I think if you're still in the midst of buying and you're worried that you disclosing it will hurt yourself, you can actually ask for a special dispensation.
Oh, really? Dispensation?
Yeah.
Really?
And,
okay.
and I think that Buffett asked for dispensation about financial that he was buying. So there's some rumors that they're buying Goldman Sachs. because that would make
Well,
sense because they did the preferred share in the GFC.
He did the big pref back
Yeah.
in the day. Exactly. Yeah.
Yeah.
Well, he did that on that and on back as well, right? Like because he's Warren, he can do that, right?
For sure. And you know, he loves those kind of down and out financials. Like he came to 𝗬𝗓 Brothers, aid way back when they did the bond rigging scandal and stuff. So he's kind of so the fact that the CEO is doing a little too much DJing probably is pretty minor for Warren compared to,
but it shows you, and you know this, right? It's amazing, how things are shoved under the rug when the stock price is rocking. When it's not, every little thing that's got to be the reason why this thing isn't doing well. That's why it's amazing, right?
Isn't that like, let's talk a little bit about that, because people always think that news makes prices, and it's completely the opposite way. That's like prices make news, and
it is. I am guilty as charged. I hate to say it. I try not to be, living and dying by, and it's not because I'm, reliant on it so much. It's just, I don't want to lose. Who wants to lose?
Right.
I want to win.
But it's just, let's just take the bond market, for example. Bond market's gone, and it was 5% on the 10-year, a month ago, and the world was ending, and the U.S. government wasn't going to be able to fund itself. And now all of a sudden the bond market's 10 years, 4.25, whatever it is. Everything's fine. And all of a sudden nobody talks about the U.S. government not funding themselves. And I'm like, did our finances really improve? Like,
I suppose, and I say this to myself a lot because here I am, kind of questioning it. And then the other side of it is that's what allows you and creates the opportunities, right?
Oh, for sure.
But it's hard. It's not easy when, to your point, every headline 6 weeks ago had something to do with, we've breached these levels, higher for longer. And, fast forward 6 weeks later and, we've got, you wrote a good piece the other day about, expecting hawkish rebuff.
Well, it wasn't that.
We didn't get it. We didn't get it. I thought it was right. I thought you were right. I thought for sure the Fed speakers were going to come back. FCI has eased too much. We need to stay vigilant. We could just as easily raise as we could pause, but we didn't get any of that.
No, it's actually shocking.
And I'm sure you saw, like, the Fed whisperer, 𝗦𝗘𝗕𝗓𝗏, says Fed's confident rate hikes are behind them. They're just not willing to say it.
Right. But I could handle them just being neutral, but they actually were even worse because
they were dumb.
Yeah. You had the one Waller went and started talking about cuts in March, and you're like, whoa.
And she's been hawkish.
Yeah.
I know.
Like, what's going on?
It is amazing, maybe not in a good way. Right.
For sure. And one of the things you have to say is, ultimately, in my heart of hearts, I've always said the Fed will buckle under pressure, that they will be easier. And I just didn't expect them to buckle so quickly. Like, they're almost getting ahead of the buckling early so that they don't look like they're buckling.
Like it, for sure. I was listening to a podcast earlier and the sort of uniform consensus view now is like 100 basis points plus of cuts everywhere.
Yeah.
Europe, America, Canada.
The thing is
extrapolating that, I realize you're doing the solve for equation here, but like GDP growth around 2.5%. I don't know.
The thing about
is that crazy now? I don't know. Maybe it is, right?
The thing about cuts, though, is that people assume that because the market's pricing in 100 basis points of cuts, that's actually the market's expectation of the future path. And it's not. It's actually the distribution of, like, it's either going to probably be 250 basis points or zero. Right. And there's very few times that you get just we had one in 98. We had just this little bit of cuts in 95. But most of the times it's just like they stay flat, and then they have to, cut rates huge.
And then something happens and they got to react.
Yeah.
It's I suppose, and I'm sure you agree with this. I've never felt like investing was easy. and maybe that's just me, but I don't recall a period. I would say, so I started looking at the markets, regularly and with some level of analysis, 96, right? And, obviously looking back, there are periods where it was clearly benign, but I don't ever remember feeling particularly, super comfortable at any point in time. There was always something to worry about.
100%. I always laugh about the people who say, oh, you know what, if I was if I was as old as you, or I would have made a fortune doing whatever. And I would have been like, no, you wouldn't have. It was really hard. There's somebody today making a fortune that you don't know about, doing something that you aren't aware of, that will look in hindsight so easy and obvious.
100%.
Yeah.
I was going to say, and I'm sure you've encountered this, and the really brutal part is I don't have a comeback. Okay. Somebody will say, well, why didn't you just own the triple Qs? And my response is, I don't have a comeback. Yeah. I wish I had. Yeah. I really do. I wish that's all I had done. Just put my money in triple Qs and walk away for 15 years.
Yeah. Or why, when you moved houses, we both are from Toronto. Now you're in Kelowna, but every single house, I wish I just rented it out and kept 100%. The mortgage.
My goodness. It's to your point. The point is it's just always difficult, and you always got to be, and that's why it's fun, right? Because it changes all the time. And even honestly, having been writing for the last year and a bit, and so, being in print, aging myself by saying that, but you're in print and people can look back and go, man, that was really dumb, Lansky. Why'd you do that? Or why were you writing this? It's okay. Right. I mean, you're going to make a million mistakes, and that's part of the key is learning from those mistakes,
for sure,
right? Or attempting to.
Well, that's my tagline. I joke and say, all I bring to the party is 25 years of mistakes. I do need to change it to 30. Okay. Let's talk a few more stocks. Do you have, what's your favorite, right now we have gold stocks on the run. Do you have a gold name that you like?
I don't own gold stocks.
Oh, you don't? You're one of those guys.
I'm not a gold guy. No, okay. I've owned a few in my time, but I do not own a favorite gold stock.
Now
I would be giving you Winston's favorite gold stock.
Good old buddy Winston. Okay. Well, I'm worried about asking you about this next one, because I'm worried you're going to give me Winston's name here. Uranium. I know you're somewhat kind of partial to the thing. Why don't you tell us your opinion and kind of how you're playing it? And do you worry it's gone too far too fast?
So I always worry about things going too far too fast, especially in a market that is, somewhat opaque, right? Yeah. I mean, that concerns me, but what I think is, and again, I'm going to use a dangerous term here. What I think is different this time is, okay, you see, I knew you'd laugh. I knew you would laugh. What I believe is different is that it matters where your uranium is coming from. In other words, if you surveyed the average, and I know you speak and read Cuppy's stuff, so but he would say the same thing, right? Like, if you surveyed the average American and asked them how much of your power supply is nuclear, they would vastly underestimate it. Number one. I think number two, they would not know that a good chunk of the enriched uranium comes from Mother Russia.
Right.
Right. And so that vulnerability, we sit here over in North America laughing at how could the Europeans allow themselves to be captive to Mr. Putin and his gas supplies.
Oh, yeah. Right. That's such a great analogy.
Right. And yet here we are with, our uranium enrichment. Now we just fired up 𝗦𝗘𝗘𝗜𝗔𝗟 in Illinois. So we're starting to rectify that. I guess my point is, national security concern, it's really honestly part of the reshoring thing, truthfully. Right. Yep. I think, so I believe that that's very, very important. Okay. And so that steers where I'm interested. Okay. And, but I'm still worried about the, price, but, commodities, as are based on, what's the marginal cost of supply, right? and uranium price is kind of, but not really even at the marginal cost of supply. Like, you know, I'm not close enough with all of the mines to understand specifically, but I think it's got to be $100
for sure. It was so far below before.
Correct.
Yeah.
And so, and then the other thing is, as you know, and again, 𝗬𝗑𝗖𝗓 does a way better job covering this stuff, but just my rudimentary comment here is secondary sources of supply are basically gone. Moreover, as you know, we have financial players, the big one being 𝗬𝗏, right, who are vacuuming up whatever spare supply is for themselves. And so the market is tight. If we have any hope of achieving net zero, there has to be a nuclear renaissance. We're actually finally, you know, the U.S. is getting on board, even though Jim Cramer swore it was never going to happen. It's going to happen.
Well, isn't that make it happen? Isn't that make
the inverse Cramer? I know, but honestly, I got to say, one of my favorite investing books is his first one, Diary of a Wall Street Addict. I think it is.
Why do you like it so much?
Because he, you know, Kramer-Berkowitz was at the forefront of the idea of, I'm going to be every sell side shop's best customer, and therefore I'm going to get the best information, the best fills,
but wasn't
all the nods.
Sorry to interrupt, but wasn't he really just emulating what Steve Cohen was doing at SAC?
I think so. Yeah, I think that's fair.
Okay.
But I guess my point is,
Steve Cohen didn't write a book about it.
That's right.
Yeah.
Steve was too busy making many more billions, right?
Right.
And Kramer needed to get on TV. My point is, I guess the point is, it's a really well written book. It's full of humility. It's not arrogant at all.
Oh.
He gives most of the credit to his wife, as you know, and to his trader Todd, right?
Yeah, Todd Harrison, right?
Todd Harrison. Yeah.
I got to go reread it. I haven't read it in ages, so that's a good heads up. I didn't realize.
I think it's a fantastic Wall Street book.
Okay,
for sure.
I interrupted you on your nuclear renaissance of
uranium. So the nuclear renaissance, Kramer says it's not going to happen. Now it is, and I think so. You know, I believe that the Athabasca Basin, obviously in our good old Saskatchewan, is going to be absolutely a strategic asset. And, you know, is it crazy to consider that if let's just say 𝗬308 goes to $100 next year sometime, okay? Do you not believe that one of these big guys decides I gotta have, like, you know, they're all trying to, other than Glencore, they're all trying to clean up and become more, you know, green metal, right? I don't think there's a more green metal than uranium. And so I don't buy things for takeouts, but so I'm long, I own Sprott, physical uranium. That's my biggest position.
Right.
Second is Next Gen, which is our good friend's favorite. And but I agree with them. Again, the metrics are staggering, not even assuming aggressive pricing. And then I have a very small position in. Don't
say that one. You know what we'll do? We'll tell people to go to your blog and find it.
Yeah, perfect. Yeah,
because not only that, it's a very small stock that you're going to move. So if you're interested, go to No Straight Lines Investments, and you did write. And I think this was before you went paid. This one.
That's right. I did.
Yeah. So you can just go search for uranium, and you'll see that one. Okay, so now that's your resource that you actually invested in. Do you have other ones? Like, do you do oil? Do you do anything like that, or are you mostly industrials and consumer?
No, I am invested in oils. I own CNQ.
Oh, the old favorite.
Yeah, it's a machine, dude. I mean, it is. I would love to tell you that I didn't own it for a good reason, but there's no good reason to not own it. It is absolutely a machine.
Everyone that can read a balance sheet and tells me about companies just says that this thing is just so well run and just
it's unbelievable. And you know what's interesting is it's run by committee, right? There's no actual CEO.
Oh, I didn't know that.
Yeah.
Well, so
Yeah.
what do you think the key is? Why are they so much better run? What do you think is the secret to their success?
Well, I would say part of it, just by what I just told you, I would assume, and I've never spoken to management. Okay. Again, why would they call me? But I believe it's the different inputs into the process, right? There's always been 5 or 6 heads at the table, and every decision is a group decision. Now, some people might call that inefficient, okay, but it's obviously working, and we would obviously be nitpicking about it if it wasn't working, but it is working, and so that's something that is drastically different than anywhere else.
I wonder if the committee aspect stops the kind of ego from making them like do stupid things. Like it's certainly, it's a good point. And I think it's true. I do. I think that they haven't, it's sort of like with the banks in Canada, right? Like the sort of joke about that is that if they were just simply the retail bank oligopoly, they would trade at much higher multiples, right? Because those businesses have a absolute guaranteed 20% plus ROE, 3, 4, 5% growth, and they generate so much cash that the inevitable part of the business is they end up blowing it in other spots, right? They always, I worked at CIBC, which was always said at the bank that's most likely to run into a sharp object, right? Sharp stick. That's right.
Right. And so, and
you guys did a good job.
I know being a CEO is difficult.
You did do a good job of it. Or they did. Like they had a lot of big.
They did. They 100% did. Yeah. And so, I guess with CNQ, they haven't tried to outsmart themselves. Like they have a really good business. They execute. They buy things counter-cyclically. They're just really, really smart. And so, I own CNQ. I own ARC Resources. I own, my sort of torquey name is Logan.
Oh, I don't know that one. What is that? Logan.
So Logan is a spin out from Spartan Delta.
Okay.
And if you follow the patch, which you clearly do, there's a handful of management teams that are cream of the crop. The folks that run Spartan Delta, Fotis and Rick, they're two folks, once it could be by luck. If it happens twice, it's more than luck. They've sold 4 companies.
Isn't it amazing how people, the smart ones, just seem to be able to do this over and over
again?
Yeah.
And here's the crazy thing, Kev. Spartan Delta, when it came public, they literally bought their asset within 15 days of oil trading negative in April of 2020, right? Now they've been working on it obviously for a period of time, but it came public at that time. They never got real institutional sponsorship for that stock, and it 15 bagged.
Right. Oh,
and yet they've done it before. And so anyways, Logan was spun out of Spartan Delta in July, just started trading. Rick, who's of Rick and Fotis. So Rick is the executive chairman of Spartan Delta. He's the CEO of Logan. And it's a really interesting company with a massive land position in the Montney. And they just released their Q3 results. I wrote it up a couple of weeks ago, but really, really promising initial well results on, you'll love this, the last wells drilled on the land were 2017. So literally all he had to do, he's like, look, I'm just going to do modern frac technology. They had a few different ideas about one of the 2 areas where they were drilling, and they proved out, right? Now it's 1 well. Okay. So I'm not going to extrapolate yet, but it's certainly better than drilling a duster out of the gates. Right.
Okay.
So, yeah.
Okay, so you know what? We've been chatting for a long time. I'd love to. I'd love to go talk about many other things, but we should really kind of finish up with our questions here.
Yes.
So first of all, what do you think is the hardest thing to do about trading or investing?
I think the hardest thing, I thought you gave me this question in advance. For those of you that don't know, so we do cheat a little bit here. So I don't want you to think I had this off the top of my head. I was trying to think of a clever answer and I couldn't come up with one. So I think the hardest thing is that investing is not a science. There's a lot of psychology. And, I'll use an analogy that I hope you find appropriate. If you went back and analyzed all of the one-hit wonders music, right? One-hit wonders over the last bunch of decades, it would be pretty difficult to figure out what they had in common, right? Other than they just, for whatever reason, right place, right time, right tune, they captured the zeitgeist, right?
All right.
And with stocks, you could, I think Brad Dunkley has done a job on this. I'm sure he's a great writer and a great investor.
We actually had him on the show. So
Brad has a soft spot in my heart because he's a fellow Laurier grad.
Okay.
We always have to back each other up, but he's also a friend, and I have a ton of respect for him, needless to say. But he wrote a piece in one of his musings years ago. It's the old anonymous, here's 2 stocks, here's all the numbers, and okay, what happened over the next year? And it's inexplicable, but for whatever reason, one stock massively outperforms the other, and it might not be the one that you would pick.
Yeah.
Right. And I think that is a microcosm of investing, and what makes it so darn difficult. It can drive you crazy, but it can work to your advantage as well, right? Because there are times when you're right for the wrong reasons, for lack of a better way of putting it.
Well, and also,
right?
This is the one thing I always say is that if the market was so efficient and so perfect, then there wouldn't be opportunities. It would all be priced in properly. So instead of getting mad about the market, you should go, okay, this is great. This is an opportunity. The market is missing this.
It's that level of conviction, or stick to itiveness, whatever it is, or maybe it's just stubbornness, right?
Yeah,
unwilling. You're not willing to admit you're wrong because you're so. Your story about that pref, right? That's a perfect example.
Right,
great example.
I think Jim Grant has this line that I love. He says that good investing is have people agree with you later. And the later part is the important part. He goes ... later.
It's my experience. I'll speak to myself. Generally speaking, 85% of the time I own an equity is painful. I think that's fair. I think that's, and I wish it was not true, but I feel that that's true.
That is actually a great line, and that is so wise. Okay, next question. Don Cox used to say you shouldn't invest on what is on page 1 today, but what is on page 16 on the way to page 1 tomorrow. Do you have any trades or investment that would get the Don Cox seal of approval?
I think, so we talked about one already, which was, the potential for a capital markets rebound. I don't think anybody's talking about that right now. 2, space.
Okay.
And I own a company called MDA, which some people may recognize, but it's not your mother's MDA. It's different.
Okay.
And there's a lot of money. Like the growth in space is huge.
This is MDA in Canada, right?
MDA is in Canada,
yeah,
correct.
I'm just looking at the website, mda.space. And so what do these guys do?
So they have 3 businesses. One is one we probably all know, Canada Arm.
Well, that's what I was going to say. Is it the old Canada
robotics?
Arm? Yeah.
Yep, they do the Canada Arm, and there's more Canada Arms on the come, with the next International Space Station being built.
Okay.
But the truly growth part of the story, I think all 3 businesses are interesting. So they have geointelligence, which is radar sat, which is effectively Earth imaging for commercial and government customers. Okay. And then the third business is satellites. And that's where all the growth is coming. And the reason is that the cost of launching, I'll just say low Earth orbits, the LEOs, has come down 95%. And so it is now economic for the likes of Apple and Amazon and Google and, pick an enterprise to have their own satellite network. And what's really cool about MDA is they have come up with a platform. They're and I'm going to get a little technical, but I'm not a technical person. Software design satellites that basically reduce. Here's the key point. They announced an order from Telesat, okay, and that's where the stock, if you look at the chart, it gapped from like 10 to 12.
Okay.
Back in August.
Right.
I did not own the stock at this point. Okay. That Telesat deal, they are reducing the cost. The initial costs were estimated at $5.5 billion. And along comes MDA and says, we can do it for $3.5 billion. Just think about the magnitude of that difference. Okay. Right at the time when there's a bunch of companies looking at, potentially launching their own LEOs, and potentially, I'm going to use a word that I try and get into my daily vocabulary, disintermediating the telcos, right? And it's now economically more viable. Ask yourself this: would Apple rather carry their signal on their own network or use Verizon?
Oh, that's fascinating. I never thought about
that. And so the growth, I would just say this: listen to their latest conference call. My view was, if you can show people that you're going to save them 40%, at the very least, if they hadn't considered you as a potential supplier, they have to pick up the phone and call you.
Right.
And they announced their first such order since that deal was announced 2 weeks ago. And it's $750 million if it goes all the way through. And this is for a company that it's going to do about 800 million in revs this year. So think about that. It's material.
That's great. That's a off the off the beaten track example. So that's MDA in the Canada. Does it trade
MDA in Canada? The simplest way to use language that you like, it is uncorrelated to anything else you own.
Okay.
Right.
You're absolutely right. I like it a lot. Okay. Now we're going to do the question. You're going to get a question from Peter 𝗏𝗏𝗧 from last week. I'm going to just play it here.
So this is not necessarily a market related question, but I think for all of us in this business, if you want to be really good at it, it's all consuming in a way, right? It's 24/7. It's even when you're out of the office, a lot of times you're thinking about the markets. And to the next guest, are you thinking about the markets when you're not in the office? Are your weekends consumed when it's not with family stuff? Are you reading the papers? Are you reading the stack of research that you brought home on Friday afternoon? Are you always thinking about the markets?
I was joking with a buddy and saying that I think, Peter, that doesn't sound very healthy.
No, it doesn't. It sounds like a cry for help. But all joking aside, it's a little bit skewed, and you appreciate this because I publish on Monday.
Yeah.
My weekends are quite stacked full of, reading research, et cetera, et cetera. But I think that I'll answer it this way. Yes, I am consumed with the markets, but I don't believe it's unhealthy. And I'll explain why. You and I are of the same vintage, so I think you'll appreciate this. As you get older, you start to be less apologetic for who you are. Okay.
Oh, that's yes.
And what I mean by that is you know what makes you tick. You know what makes you happy. You know what motivates you. And for me, I love the market. I love looking at the market. I love analyzing the market. I love understanding where I got things wrong. There's always something new under the sun. And I don't want to apologize for that. And I think the key is, of course, you have to have a partner. And my wife is the best. She absolutely understands what drives me. Having said that, it doesn't interfere with the things like I like to have, we talked about cat skiing, but there's all sorts of things that require focus, such focus that you can't think about the market, right? Like if I'm thinking about the market when I'm, skiing down a hill, I'm likely to hit a tree. I don't want to hit a tree. Hitting a tree has consequences. So I'm not going to think about the market, right? Another example, you'll laugh at this, but this is a true story. Years ago, I was invested in this company called Wabash National, WNC. They make trailers, okay? Like transport truck trailers.
Right.
And so we made a game when we were driving down the 401 from Toronto to Waterloo to visit my dad, counting Wabash trailers, and whoever got the most won, right? So Wabash, it's sort of like, punch buggy red, punch buggy blue, right? So I think my short answer is I am consumed, but I balance it. I understand you can't be a big stress ball. That makes you less effective, right?
Great.
So
that's a good answer.
Yeah.
Okay. So do you have a question for the next guest?
I do. My question is quite simple. If you weren't an investment pro, assuming that the guest is going to be an investment pro, what would you be doing for a living?
That's a good one. I like that. Although still my favorite question so far, and I should really encourage people to not be afraid to ask outside the box questions, was if you had to eat something for the one meal for the rest of your life, what would it be?
Oh, goodness. Yeah.
Okay. So
what was the answer? I'm curious.
You know what? I think we asked Jason Shapiro, and he was like peanut butter jelly sandwich, something really weird. I can't remember exactly. It was strange. Okay.
Well, you had one other one too. I think the kindest thing, right?
Well, yeah. So I'm gonna end with this one. Here we go. 𝗦𝗘𝗖𝗜𝗔𝗟 from Capital Allocators often asks his guests, "What is the kindest thing someone has done for you to help you along in your career?" This is such a great question. I'm gonna borrow from Ted, so I've actually stolen it from Ted. Do you have a particular person or event that stands out for you?
100%. So when I first started in sales, you're cold calling, right? Nobody knows who you are. Nobody cares. Nobody is interested. You don't know anything. You're new. Why would I phone you back, right? That's basically what you're facing. And by the way, you're telling me something that I already know. I knew about it last year. Why are you bothering with me, right? That's sort of the hostile environment. And so the first client to ever call me back is a gentleman named Chris Blake. He's still my friend. And the reason why that was so important, I don't have to explain this to you, but I'll say it. You understand. You need somebody to take a chance on you at some point, right? Somebody has to say, you know what? I know Lansky doesn't know anything, but I'm going to call him back and give him a chance. And what happens is you start exchanging ideas and information with one person. So that person gives you one little tidbit that you find fascinating. You share it with either via voicemail or by luck, you happen to get somebody else live. You share it with them. Maybe you don't give someone credit for it. Maybe you do. Either way, the next person thinks, well, jeepers, that person's kind of well informed. I'm going to keep talking with them. And it becomes a snowball.
Right.
But without that one person, Chris, taking a chance on me, I was dead in the water. It's never going to happen.
Well, that's great. That's great. Chris, Jonathan, thanks you. All right. So yes. Jonathan, I guess, before we, actually, why don't we tell people about your letter, and then I want to talk to you about skiing a little bit.
Sure.
So tell people, you write this letter, great letter, no straight line investments. Why don't you tell people where it is, how it works, what sort of things you would find in your letter?
Sure. So it's on Substack. So, Kev and I both use Substack. I think it's a great platform, really user-friendly. So it's nostraightlinesinvestments.com, nostraightlinesinvestments.ca or .org, all one word. And the letter is basically it's a macro, starts out with a macro wrap, but ends up with a bottoms-up stock picking conclusion, if you will. In the midst of that, I will write about all kinds of things that I think are interesting and worthy of sharing. There's a bunch of, I do charts of the week. I do a flow analysis because as we were talking about earlier, talk is cheap. You got to follow the money. And so, I believe it's look, it's a labor of love. I'm a passionate market person. I'm going to keep doing it till the day I die. And I think you'll get something out of it. I think it's worth checking out.
That's funny because you know what? My wife always asks me that question. I'm like, I just plan on writing it forever. And she's like, what?
Why would you stop? Right. I mean, if you honestly, Kev, like, I don't know about you, you've been doing it a lot longer, obviously, like multiple decades, but, for me, it literally, it helps my process.
Oh, 100%. If you want to know want to know a topic, write about it.
Correct. Yeah. Right. And also, you're not going to be, I'm going to use the word again, but it's true. You're not going to be glib with your opinions, right? You are going to make sure that you really believe in what you're saying. And, the other thing, you're absolutely prepared to be humiliated because it will happen, right?
Okay. So,
and it has happened to me.
For sure. It's happened to all of us. So we got to finish up with our story about our cat skiing. And so for those, like, I literally just met Jonathan, and it's funny because literally we have all these friends that are like, that we both know. And the reason that we
1 degree of separation.
That's right. And the reason was for many years, probably like a decade, we had, we would go to this cat skiing operation called 𝗪𝗘𝗕𝗜𝗔𝗥. And you were the organizer of the trip right before me. And I would go, you guys would be leaving and we would be going in. And and sometimes our guys would go chat with you because there would be some people that knew you, and I just never came up and said hello, and I really should have. But you were laughing and telling people. Why don't you kind of relay what you said about the luggage?
Well, so one of the sort of funny little quirks of Mustang is they like to put their guests to work, and I think I'm sure you would agree with me, Kev. If it wasn't for the owner was the first person to always put themselves to work. So everybody else just kind of pitches in.
Right.
Anyways, so the process is the group that's coming off the hill would first help unload the group that's coming to the hill from the bus. So we'd go over and literally do like a line of luggage. Each person just passes it along. And so the joke was Kev and I probably passed luggage to one another, and we didn't even know
That's
it.
right.
So there you go. Small world.
So do you still cat ski?
I do not. And the reason is that because I am fortunate enough to live close by the ski hills here, I just sort of try and poach the best days.
And is it
Big White is?
And does that fulfill your need?
From my door.
Like, does that fulfill?
Pardon me?
Is that good enough? Does it fulfill your need?
Well, I hate to say that I'm getting old, and so my aspirations have declined. But honestly, I would look at it. I look at it this way, Kev. Honestly, like if I ski for 2 hours of pretty intense powder, I'm pretty tired.
Yeah, no, I listen. I'm the same way, and I
go up and ski laps for a couple hours, and then I'm done. And I think that's the ultimate luxury. It's why I moved here.
Oh, no,
it's
one
great.
Of the
big reasons.
I know there reached a point, and that's why I stopped organizing the trip, where we got to sections, and we'd be like hiking up some cornice and like going around, and it'd be like I'd be looking down at these things, and I'd be like, why am I doing this? Like
all you're thinking about is the consequences.
Exactly.
That's probably when you know when it's time to sort of close up.
And I always used to say, like, all the young guys would be, let's go do some steep stuff, and I'd be like, what about those old man bowls, like those big old man
100%.
bowls? That's all I wanted was just.
Back to what we were talking about earlier. I mean, you become more comfortable being a wimp. Okay. I'm okay. I don't need to be, living on the edge and concerned about, tumbling to my death.
Okay.
I don't think that's heroic.
So I got something.
I don't think my kids would or my wife would.
That's
either.
right. So here's what we should do. We should organize a trip where we go and we hike up just a nice old man bowl, like spend all day hiking up and then just ski down, and we'll get the groups together and we'll go and I'll get to meet you in person, and we can pick a nice day later in the season when it's not too cold.
Done.
Okay.
Done. Yeah, that's the other thing. I don't like skiing when it's cold, and unfortunately, usually when the snow is best is when it's cold.
Right.
So, my sweet spot now is juicy fruit ski days, mid-March, sun shining, slushy. Like, I love that. I love it.
Okay. Well, listen, it was a real pleasure getting to know you, and thank you for sharing all your stories and your thoughts and your ideas, and we really appreciate it.
Kev, I can't thank you enough, and I really appreciate the chance to gab with you. And like you said, it was just great to get to know you.
Take care.
I appreciate it. Okay, take care.
All right, Patrick, it's time for Talking Charts. Lots going on. This should be a good one. I'm looking forward to this.
Well, let's do this. So first of all, let's talk about the economic news and what we were looking at 2 weeks ago for the things coming out. Obviously, we were looking at the ISM was a disappoint. It came at 46.7, at least for the manufacturing PMI. The services PMI comes out next week, but these numbers continue to be weak, and I think that continues to reflect an economy that is kind of diverging from what the markets are trying to advertise.
It's interesting. I was listening this morning to on Bloomberg. They had the actual PMI fellow on talking about it. And I think this is one of the longest periods of where the ISMs are below 50, meaning contraction, that we've had like ever, or at least in a non-recession environment. And it just kind of leads me to think, I'm wondering, like, it's so bad, Patrick, it's got to bounce soon. And if this is, like, what's going to happen when it bounces is it's interesting because we have the markets running ahead and doing great things, and yet the economy is doing terribly, and it's showing more and more signs of just not, picking up. And what's going to happen if the economy actually starts to do better?
Yeah, but I think that there needs to be some sort of stimulus put in to really turn this up. I mean, there's a
I don't
lot
know,
of
though. It just is so bad that it just feels like it could just bounce naturally. Anyways, it is interesting, and there's just so many things in terms of this cycle that we've seen that have never happened before. And I still go back. I think Dario Perkins from TS Lombard has the greatest line about this. He's been arguing for a long time that this cycle has looked nothing like previous cycles. We had a government shut the economy down, send everyone home, then handed everyone a bunch of money, opened fits and starts, and we're all expecting this to behave in terms of a regular business cycle, and it's really confounding a lot of people.
I agree with that. Anyway, number 2 is Core PC Index. It really was a nothing burger. Came right in line. Did you want to add something to it?
No, nothing to add.
No. And otherwise, it's a new bull market. Well, the market keeps ripping higher. But we haven't seen the markets make higher highs yet. I know a lot of people keep watching this from a percentage perspective, but I think we have to first see what the market does during a pullback and whether it's bought on dip and the way that things progress. I still think that there's a lot of things that can go wrong in the new year.
Have you heard, Patrick, there's no more pullbacks?
It's true.
Especially
not in the Mag 7.
Well, actually, funny you say that because it's actually this week we saw the leadership change.
You like, and in what sense? Which stock? Come on. Listen, we'll talk about it on the charts.
Okay.
Let's actually pull up the mags and actually have a deeper conversation on that. Anyway, let's talk about the top 3 things to watch over the next 2 weeks. Number 3, inflation numbers. And it's interesting because obviously we're going into the holiday season. And we have everything from central banks, inflation numbers, jobs numbers, everything's coming out in the first 2 weeks of December. And so after that, you have to think that things are going to get pretty quiet going into the holidays. And so it's going to be really interesting to see how much volatility we get here in the next 2 weeks. And inflation numbers next week is one of them. Is there something you think that it's going to be another surprise, or is it just going to be more of the same?
I don't know. I'm not sure. I'm worried that a lot of people are expecting inflation to really be well behaved, and the little part of me is just continues to think that there's more inflation in the system than we think. And given the expectations, I worry that the surprise could be to the upside. With
the way oil and nat gas and all these other types of commodities are trading, I don't think the surprise comes this month. It's not that you're going to be wrong, but I don't think it's this month.
Okay.
That surprise happens.
What's number 2
is the jobs numbers.
Yeah, I think that's actually more important.
Yeah. And so it's going to be really interesting. Of course, when you really look back, jobs numbers and unemployment don't really start spiking until we're already in the recession. And so this is why watching on balance of probabilities, you have to almost assume the job numbers won't uptick in this month. But if they do, that would actually, I think, be taken pretty negatively. What's your take?
Yeah, no, I completely agree with that, Patrick. And I think it would people are going to be hyper-focused on it and trying to glean any sorts of, hints about economic weakness that they can see in there.
Right. And number one, it really should have not been just FOMC, but central banks in general, because we have Bank of Canada next week. Then we have obviously Bank of England and ECB all coming up in the next 2 weeks. So it's all pretty much lumped into that week of the 10th to the 16th. And but the FOMC obviously is always the big boy, and that's the one everyone's going to be watching. Do you think Powell does anything different or is he going to just give more of the same?
I've been actually surprised at the FOMC board members' willingness to accept the easing of financial conditions that we've experienced this month without pushing back against them. And we're taping this on Friday at lunch, and Powell just finished speaking. And although he did push back a little bit, it was pretty minor. And you kind of actually have to wonder what's going on. Why is the Federal Reserve so willing to make this pivot? And then, and don't forget, the pivot was based upon the fact that the tightening of long rates, meaning the rise in long rates, was actually doing a lot of the tightening that they needed to be done. And yet that's all being reversed. And they're still saying everything's fine and, continuing on this kind of dovish, like at least pause. I wouldn't call it a pivot because it's not a pivot, but it's a pause. Yet what was interesting, Patrick, was a couple of FOMC board members this week actually suggested that that we would be lowering rates in early 2024. And if you look, the market has taken out a full hike. A full cut, put in an extra cut in the first quarter of 2024. And that's been fueling this rally. And I've been absolutely flabbergasted that the Federal Reserve has done this. I don't see any point in doing this. I don't know why they did it. I'm just kind of surprised. I ultimately always thought they were going to panic and actually succumb to political pressure and be easier than the market expected. I just didn't expect them to fold so quick.
I can't imagine the Fed cutting into a period where equities are making all-time highs and things are going very well. I mean, there's the cliche thing of the Fed ultimately cuts when they break something, but there's some logic to it, which is essentially they start providing liquidity when the economy actually needs it. And the idea that they're going to start easing and give the economy some juice while this hasn't been priced into equities, and equities trading at all-time valuations, not all-time valuations, but very rich valuations, it doesn't add up in my head.
Listen, I don't disagree. And that's all, but like they've been oblivious to what financial conditions have done this month. And there's been no pushback on it. In fact, one of them, I can't remember which one of them, talked about the fact that the financial conditions were still relatively tight. And I was like, what world are you living in? And I think they're kind of clueless. And the only part of me that wonders is if at the end of the day, are they seeing signs of economic weakness more so than we think? Or are they just getting pressure from the fact that they've risen rates this high? It's been, terrible for the government. It's been terrible for the corporations that are going to have to kind of refinance in the coming year. And they're just looking at it and saying, no, we went too far. And they're trying to walk it back.
Just to look at the current pricing right now for the March 20th Fed meeting, the CME Fed Watch tool is assigning a probability of 53% that there's a cut and only a 40% that they're still unchanged. That means that it's now pivoted to the point that they're pricing in a rate cut cycle in the first quarter.
Yeah. But that's not surprising that the market is pushing the Fed that way. What's surprising is how little pushback we've gotten from the Fed about that. And there's been lots of opportunities for them to change that, yet they haven't seemed to grab it. And that's what I'm confused about.
Right. Well, look here, unbelievable move in the 2-year note. Like, look at this gap. Yeah. Isn't that insane?
It's a big move, and is that the roll?
I think that's that's the roll. It's the roll. Yeah. You know what? I just thought of that. Let me just quickly check. There we go. So let's look at the March
You
contract.
can still look at December. It's still trading if you want to do that.
Oh yeah, okay. Well, sure, because it's going to be a cleaner chart.
Yeah.
So the but it's still turned
No,
up.
it's a big move. There's no doubt about it. And
it's for a 2-year interest rate move, but you've got almost a full point higher on the 10-year bond. The 30-year bonds ripping not as much. To 10 years moving most, but it's a lot of the interest rate pressure or the interest rates are coming off, and bonds are finally coming to life.
Yeah,
and they started working since you've taken your profits on your bond trade, right?
No, that's not true. I just first of all, I just want to remind everyone back to late October when everyone was lecturing us about term premium, right? Like all the worries about term premium have gone. Like think back to how pervasive that bearishness about bonds were. Like at the time, it seemed like the government wasn't going to be able to fund itself, and yet here we are, and the things rallied huge. And it just goes to show you that the prices make the news and not the other way around.
It's it's almost like the trend happens during the speculative phase, and then the reality phase is the counter trend move. It happens that.
But everyone was so worried about the government financing themselves, and they were worried about the deficit. Now, let me ask you, Patrick, did anything change in the last month in terms of the government deficits?
No.
Right? And yet now everyone's like, it's no big deal. They're going to be fine. It just goes to show you that a lot of times when that kind of narrative on FinTwit and in the financial community just kind of overwhelms it, you have to start thinking about going the other way.
Yeah. No, it makes sense. Let's just stay on bonds for a moment, since we started this topic right off the bat. Look at investment grade bonds, the way they've ripped right back to their summer levels. Just that entire bloodbath. They've been almost leading the way. The investment grades have been just getting a lot of love. I mean, this is one of the stories that you were talking about a month or two ago, just simply the advantage of being in corporates bonds over that of equity, and they've just been running. You think that this is something that can continue to work? Well,
I talked about the advantage of being into corporate bonds over equity, but let's face it, they both gone up. So I haven't been right about that. Like I thought the equity risk premium was gonna make it so that you would you'd sell your equities and buy
but that's
bonds.
A big picture thing. It's not a short term
I
thing.
agree. I'm just saying that it's just that they've both rallied. One of the things that I would worry about if I was as an investor is the fact that we have increasingly have a situation where the correlation between stocks and bonds are positive. So everyone's breathing the sigh of relief and rushing into stocks. But at the end of the day, we still have a situation where they're positively correlated. And I'd feel better actually if they started to become a little more negatively correlated.
Oh.
This whole rally has just been one big, it's been US dollar down, bonds up, stocks up. It's all moving.
It's called
together.
Intermarket analysis, dude. I mean, this has been a classic risk on.
I get it, but a lot of times you don't get the bonds going up with the stocks like that, right? Especially
but the one thing that's been the story for the last 2 years has actually been the breaking of the inverse correlation of stock and bonds. They seem to now kind of be trading in unison almost.
But that was my point. Is that be careful about being excited about stocks because they seem to just be going up because of this correlation with bonds. And I guess it depends on what you feel about bonds, but if ultimately you're a big, huge bond bear, which, let's not forget a month ago everybody was, then you should actually be worried about stocks.
Right.
And anyway, so back to the bonds, Patrick, I think it's a time. This rally's been ferocious. I think you should be, if you were lucky enough to catch it, you should be selling your bonds up here. A lot of the worries that the people were worried about were legitimate.
But are you talking bonds right across the spectrum? Corporates, junk, everything?
Well, I think corporates, first of all, are too tight. I think that's kind of crazy. So I would sell the corporates.
The credit spreads are it's back to like ridiculous levels.
And I think that bonds, they've gone from a period of this huge fear, and we've had this relief rally, but I think they're going to get quiet now. One of my kind of themes that I've been talking about a lot lately is the fact that the move, which is kind of the VIX for bonds, is still up there and it's still high. Meanwhile, the VIX is on the absolute lows. So I really like buying equity vol and selling bond vol. And one of the things that, if you are interested in this, go listen to the Harley Bassman, piece that we had where he got interviewed for the MTBA, because those mortgage-backed securities, implicit in there is a higher volatility assumption. And if we get a situation where fixed income volatility settles down, those could be big winners. So I really like buying MTBA and shorting like corporate bonds against it.
There you go. The interesting thing is just the rip that junk bonds have had. And, obviously you've talked about duration and where most of the junk bond maturities are, because these companies clearly haven't had to deal with having to refinance huge tranches of debt at much higher interest rates. That date is coming at some point in the future, but like right now, these junk bonds, they're back to 2023 highs.
Yeah, it's like everything's great with the world, Patrick. Bye.
It's all right. S&P 500 up 25 points, but it's not just up 25 points. But if it closes up here, this is the highest level we've traded since the summer, and the S&P
it's almost all-time highs.
Well, yeah. Well, no, all-time highs is the 2021 high. That's much closer to 4,800. And that's the big question for me. Is there enough gas in the tank for this market to actually surprise everyone with a further rally that actually breaks the 2023 highs and heads up to 4,800. Now, one of the things that I've been talking with my members is that we obviously the tell for me is about what a pullback looks like. And, because when pullbacks are very shallow and well defended, then that's usually a sign that another impulse of bullishness is coming. But this thing hasn't pulled back.
I know.
The markets don't pull back anymore.
Crazy.
Like this has been a relentless rise, and look, CTA buying, they're already near very historic high levels being long. You have most of the Vanna effect from options buying mostly done. I mean, and the VIX could go lower, but generally all of that buying is done. The implieds are narrow, so vol targeting funds have loaded up. So the thing is it what, retail investors that didn't own enough? Like where is the seasonal flow coming from in your mind?
I think people were really bearish. I think that they were underinvested. I think you forget how much people assumed that there would be a recession.
Yeah,
they were hiding in the Mag 7, which almost became a recession trade. A lot of the other parts of the market were actually very cheap. And so when we have a situation where it looks like the Fed finally is going to take their throat off of their foot off the throat of the economy, we have a relief rally in the other parts of it. And I guess the fact is that the Mag 7's hanging in there well enough, and the other stuff's going up. So on the whole, the market's rallying. But one bad thing, back to your kind of the ferocity of this rally. One of the things that I remember when it occurred, there was those breath thrusts. I got it wrong. But those ended up being really spot on. And I remember reading about them, and I can't remember all the different names or whatever. And people were like showing how that when you get that sort of across the board buying, it often just continues. And that's exactly what's happened.
Yeah.
I don't know. You have any thoughts about that? Like about those?
No. No, I don't have anything smart to say.
That never stops you usually. What you got next?
Well, listen, let's talk volatility. So, I mean, literally, we're at this moment, if it closed down here, this would be one of the lowest closes of the volatility in 3 years. I mean, you have to go pre-COVID crash to see vol levels lower. It's not that it can't go lower, but we're down here.
Okay.
And what's interesting about this? Okay, obviously, at the beginning of the show, we were plugging the special webinar I'm doing on buying options as protection, as a hedge, because it's so cheap right here. And I'll explain it in that webinar, which you can register at bigpicturetrading.com, just to make a shameless plug in the middle of it. But
lucky few will get a toaster.
Yeah,
okay.
And but when I see volatility this low, I'm thinking, how could you not, if you need further bullish exposure on the upside, how do you just not take it with long gamma instead of buying Delta One equity? Like when you can buy upside on the market at year lows, even if you're doing with call credit spreads, even if you're just using some way, even a slightly in the money option where you're buying high delta, like at least you have a limited risk if shit hits the fan in the first quarter of the year.
Yeah, I don't disagree, Patrick. This is the time you should be doing it, but this is the point where no one wants it. No one cares. No one's the reason volatility.
Everyone's
is so
selling
low is
gamma.
Because, everyone's convinced that everything's bulletproof.
Yeah. Like, look, if people want to keep pressing this on the upside, at least entertain the idea of putting it on with some sort of option strategy rather than buying the equity, and especially on margin when you're freaking paying, 5 to 7% interest rates. It's just at this point a very good way to manage the risk.
Can't disagree with you. All
right. So I want to talk about gold, $27 up.
Cool.
More importantly, I mean, it's attempting a breakout on spot price.
I saw that this was the highest monthly close ever.
Yes. And that's an interesting thing because a lot of people, so you could see all the candles, all these wicks on the monthly chart, right? Yeah. But when you put this on a line chart, which is what commonly junior technicians do.
Junior ones. Okay.
Well, because when you put on line charts, it doesn't reflect the highs and lows that the actual price traded. You're only looking at the closing price, right? Hold on, let me put it on a monthly chart on gold here. And so you can see here, based on this, on a monthly chart, we've broken out to an all-time high, right? This is the whole point. You can see it on the candlestick chart that we're still trading along the levels where it is, but anyone using just simply the monthly closes, and they're looking at it like on a chart that looks very similar to a Bloomberg chart, it's a breakout to all-time high.
Yeah.
The interesting part is gold obviously trades in contango in the futures market, right? And when you have that happening, when you actually, let's say, look at the February 2024 gold contract, which is what the gold contract that is the front month now on the continuous. We have, back in May, it was trading at 140 because it was in the contango, the gold market back then had it trading that high. And so you have a scenario where we actually haven't made a contract high, but yet the spot price is at a fresh high. And this is the big debate, as this finishes this measured move to 2100 to 2140, it still hasn't beaten the February high. So that's always the nuance in futures trading, isn't it?
But shouldn't you be using cash?
Yeah. I mean, ultimately it is correct. On a spot price basis, it's a breakout.
Yeah. And I think that's one of the things that people need to remember when they're thinking about this. And actually, all assets now, we had so long that interest rates were basically zero that it didn't matter. You just had to beat zero. But now let's just take gold. The current contract is trading at 2062. Okay, the December. And I see that the December of next year is trading $21.69.
Yeah.
That means if you own gold for the next year, it has to go up $105 or whatever that is for you to break even.
Yeah, but that's the interest rate differential and the storage costs.
I completely agree. I'm just saying that that's the reality. We don't trade spot like we trade futures that have a carrying cost. And if you do trade spot, you actually have to look at the alternative. And that this is the point that's kind of interesting that so many people are forgetting. It's like interest rates are 5%. So the stock market's going up. It's ripping, no doubt about it. It's way beating the 5%. But you still need kind of over the next year to beat that handily to say, oh, I was much better off in stocks than I was in cash. And that hurdle, that 5% hurdle is bigger than people think. And they've completely forgotten it.
Yeah. So crude oil, let's move on.
Okay.
OPEC came out, famous pop and drop. To me, there was a very big and key hurdle in the 80-82 level. Not only was it the Fibonacci zone, the 50-day moving average, descending trend line, basically oil needed to do something bullish north of $80 in order to change the prevailing downtrend. And it basically popped to 80, total rejection, reverse back down. Point is, I don't want to be bearish oil, but there's no reason to be bullish it. And on the short term, the vulnerability of testing summer lows is very real. And if you have any breakdown below that $75, $74 area, we may, poke down to 70 or a little bit lower to retest those summer lows before we get a bottoming formation. That's a really important moment to watch oil. I mean, I keep trying to be optimistic about it, but that's my bias factor. But this chart looks like shit.
There it is. The official, this chart looks like shit.
It does. Like I wish I could say it's like I have enough oil positions where I don't like what I just said, but I mean it is what
Charts
it is.
Don't lie.
The chart don't lie. It's shit.
Shakira is going to make a new song.
What continues to be crazy is the widowmaker.
Oh God, natural gas. Is that what you're going to talk about?
Well, I just need to point out that the widowmaker is making widows.
Oh, 100%. Terrible.
Like
just an awful.
Anybody who's like, oh, that's oversold, I think I'm going to buy some. No, it's got to get worse. And there is not a pulse. It's like if this is a bottom, it like there's no dead cat bounce. This body hit the concrete and splat. Like it's
kind of shocking. And my understanding is that the U.S. shale companies or whatever, they continually pump and just keep drilling for natural gas. It's like anytime you get a rally, they're just like, hold my beer.
But is it not just? I'm going to say something probably ignorant. I don't know how that works. I'm not the oil expert in the room. But isn't it that when they're just drilling for oil, that's a natural?
No, there is an element of that. There's no doubt about that. There's no doubt about it. But at the same time, they see
shale is pumping oil at historic levels, and so they just have all this excess gas that's popping out.
Yeah, no, there's an element of that, but there's still a lot of natural gas pumping and exploration and going out and doing this, and they just don't seem to learn. There's absolutely no discipline when it comes to these guys.
And so this is the ETF that's the 12-month strip, the UNL. So it's a 12-month natural gas fund, and that like the whole strip is having its face ripped off.
Yeah. You know, the only thing I will say though, Patrick, between the natural gas and the oil, this is all good for, human beings in terms of when those go up in price.
That like to burn fossil fuels.
Well, yeah. At the end of the day, we still are mainly a carbon or, a fossil fuel based economy. And this the worst thing that could happen in terms of making us poorer is having those go up.
Yeah, well, this is why I actually don't think the CPI number shocks anyone.
Yeah, maybe you're
on
right.
the upside.
You're
Like,
absolutely
it's
right.
just it's like you know what happens if from an incredibly oversold state, all of the energy plays all have a 15 to 20% rally just from an incredibly oversold condition. Then that might have a knock-on effect that causes the CPIs to have an uptick, right? Like it just doesn't feel like it's going to be this month.
Yeah, you could be right. I know that when you go do the math and look at CPI and look at what it's most correlated to, it's like gasoline future contracts is the number one thing. Like that's what you should be trading against it.
All right, let's say a few more things. Uranium. Now this is the 𝗬𝗧𝗜𝗓's down to $80.40, but it's above 80. Like that's it. Uranium continues to plug away.
Yeah, it's great
and
good for all the uranium bulls.
What I was in, because you're not right. You don't have any?
I don't have any anymore. Nope, I'm an idiot. Which is why it's going up. So you're welcome.
Yeah. Anyway, so but what I wanted to just talk about is the sell-off that happened midweek on Wednesday. Someone hit the bid in large size. It wasn't, there was no drop in the 𝗬𝗧𝗜𝗓. So this was just a factor of the premium and discounts that,
but it wasn't just in this, it was in like all of them. Like pull up URNM. You'll see that there was a big, huge on the morning that there was a big sell order there too.
Yeah. Somebody hit the bid.
Yeah.
But what I find a very important technical event is when someone hits the bid and you have that kind of a drop, what happens in the 2 following days? And if buy on dip traders come in and completely reverse the sell-off, that means that the bull trend is still strong. It's like if the sell-off happened and then it creates a feedback loop of more selling begets more selling and it feeds on itself, then the rally could be over. And the fact that the rally got bought on dip means that it's still in bull phase.
I think that's wise, Patrick.
And so, I think that this still can print $28 to $30 before we have a swing high. Eventually, Cuppy will be right, and this thing could be at astronomical levels. But I'm trying to be more realistic that that's kind of a multi-year story, and during the path there's going to be a couple washout events that everyone that gets too long and too heavy needs to be washed out a little bit before the bigger trend can continue. So it'll be interesting to see how far this trend extends before we get one of those events.
Okay.
Just quickly on global equity, and then I'm going to stop talking.
Okay.
But first of all, global equity, number one, China just can't put anything together. This is the China A50. Every rally is sold. This is the most pronounced and systematic downtrend out there on global equity markets. It's an ugly, ugly chart. This thing could easily still make 11,000. It's just making lower lows. Every rally sold. Just heavy, heavy distribution. What's interesting though is that a couple of the emerging markets, India got bought on dip pretty quickly when they had that quick October sell-off, and is almost ready to make new highs. The other one that's really impressive is Brazil. Like this is the 𝗬𝗧𝗜𝗓, and did I pronounce that right?
You're the one who lives in Portugal. Like
anyway, but this is Brazil. Well, I
get it, but you should know the language. So they do speak the same language. Am I not mistaken?
Yes. Yes. So, but anyway, the point is, look at him. It just relentlessly is pressing fresh highs. So like Brazil's on fire. The other one that looks a lot in very similar fashion, one you've talked about many times, is Mexico, kind of ripping right back to their highs after that dip. And so some of these emerging markets, the selective ones, are actually getting some flows. And the question I have, obviously we're skeptical about the sustainability of the S&P rally, but what happens to all of these kind of periphery and kind of emerging market charts that have been so strong, can they continue? That's a really interesting question that I don't know if I have an answer to, but there's charts look good.
Well, and I would say that it goes with the dollar, don't you think? Ultimately,
Yeah.
isn't that the same chart as the dollar? Like in
True.
reverse?
Well, the dollar's not all the way low, but obviously emerging markets are
Well, let's
highly
pull up the DXY
sensitive.
and let's have a look, because I think it's almost the same
Well,
chart.
the DXY is not back to its lows, but it's certainly but definitely like. But the thing is that everything went risk on the moment the dollar peaked, right? Like literally, October was where the dollar peaked, and the entire pullback in the dollar has been every asset's been freaking ripping other than oil.
Right.
And so it's hard to just say that, but historically you're dead on, which is the emerging markets have been very sensitive to dollar trends.
Now, let's talk about the dollar though a little bit, because wouldn't you agree that this sell-off has caught a lot of people off guard?
Yes. But this is actually an important inflection point for me on the dollar. Like we were looking for a pullback to this 103, 104 level because we are always looking for fib retracements and where pullback should go. But this is actually, I think, a really important moment because if for whatever reason we see peaks in the euro, the 110 level on the upside, if we see that the US dollar yen, this entire sideways consolidation has played out and it starts to turn up. If we see these kind of things happen off these levels, this is a moment where a dollar resuming its prior trend can naturally happen. Now,
maybe, but I kind of feel like the opposite. I feel like everyone is expecting that. And I think when everyone's expecting something, you should almost look for the opposite.
Well, you know what? The way I kind of think about that is if the dollar was to go and retest all of its 2023 lows. So we're going 100, 102 trade range down there, and it takes 2 months of trading down into those zones. That actually, I think, would be fuel to take the S&P to 4,800 and keep everything running for a couple more months.
So I agree, but isn't that almost the pain trade?
Yeah, it is the pain trade.
Yeah.
That is. Yeah. It is. Right? Like the prevailing trend just continuing and everyone's trying to fade it and it just keeps
they're waiting
grinding
to buy
people.
it. They're waiting to buy it or sell the dollar.
Yeah. By the way, we forgot to talk about Mag 7s. Hold on. So which one do you think is turning? Like, so Apple is still up along its highs.
I'm just saying if you look at them as a group, they're no longer leading, and it's actually we have a situation.
What's leading?
Well, small caps are doing well. Like,
come on.
Oh, it is. Like today, I'm looking at this small cap up 2.75%.
That's
QQQ is up.
That's 1
35
candle, dude.
No, but it's been this way for a while.
Okay, but dude,
listen, I'm just saying at the margin, they're no longer leading.
There was an 18% wipeout.
I'm not disagreeing with you, Patrick. I'm just saying that on the whole, the Mag 7, it's almost like money is coming out of Mag 7 into everything else.
I don't like that thesis.
Okay.
I mean, it's definitely an observation that's probably true when you're looking at over a couple of days of price action, but I think it's a foolish thing buying small caps here. I think we are not in the stage of the cycle where small caps are destined to do well. I think you're a bag holder if you buy this shit.
Okay, I think the other thing is everybody short them. I think that
that's their problem. No, I mean, they could get squeezed.
Sure, and that's all I'm saying is that we could have an epic squeeze because everyone is in the Mag 7, Patrick. I have a really good pal that manages lots and lots of money, and he was telling me he went to some conference and he said that the prevailing attitude was, and I quote unquote, Mag 7 was bulletproof. Bulletproof. And like you see that Goldman Sachs report where they showed the percentage of hedge funds that own the Mag 7. It's like 99% or something. It's
I don't, but I
everyone's-
don't think they're going to sell it. But I think they're overweight, and when they're overweight, they're going to be forced to rebalance their weightings at some point, and they're going to have to unload some of it at some stage, and it's just going to. And usually, it happens all at once, right? When people are that crowded into a trade, they trip over themselves. It's like yelling fire in a movie theater, right? It's
and listen, I want to say one thing about, like, if you go back to the quant crisis, we could have violent intra-market moves that people aren't expecting, because let's face it, there's more people trading, using systematic trading or quant or factor models. This is only increased, and if everyone's leaning one way and we get a situation where all of a sudden it changes, there isn't enough liquidity for them. So I would be really kind of aware that, don't be like, if we got a situation, let's say that small caps were up 5% in a day and the mag was down 2%, and you're like, holy smokes, I got to, this is a great opportunity, because this usually doesn't happen. I'm just saying that be careful, because that could be a sign that there's real stress. And, one of my best friends, he used to have this line. He said, what the trouble about 3 sigma moves are? They turn into 7 and 8s before they're finished. And so that's what I'm kind of wondering might happen.
That's words of wisdom. Let's move on, though. Crayons with Kevin.
Okay, I got one.
It's a segment that we fell down on last week, but
I fell down. It was completely my fault. So I have one. Let's pull up GDXJ, which is the junior miners of gold, the gold stock junior miners. I need you to go back at least a year. Okay, that chart will work. No, actually, the first chart was fine in terms of, let's do that one. Okay, now I want you to take that top in April, that high, and then I want you to draw a line down to that second one. Okay, we'll stop there. And then I want you to go and... No, wait. Have you got GDXJ?
Yeah.
Okay, wait 1 second. What am I doing?
You're not using candles, are you?
GDXJ. I need to do my own charting here. Let me just see, though, because I had a different chart, and I was wondering what...
Is it about the breakout?
Yeah, but... So why is yours different than mine? Because when I match up those lines, I get a much...
Oh, let me put on a line chart. There you go.
No, after
better?
saying that... You're making fun of me. Oh, no, you know what it is? Actually, I got it. I'm wrong. I needed to go back farther. There's the problem. Sorry. That's my problem. I am showing what an amateur I am at technicians. Okay, let's go back.
I mean, this is why it's called Crayons with Kev.
Exactly. Okay, so go back to 2020. I need you to go back, way back.
Okay.
Now, I want you to take that top in July of 2020. I want you to draw there to that one. Yes, there we go.
There you go. Oh, that's a really thick crayon you're pulling out here. I'm going to put this on a weekly chart, though, so it's just cleaner looking.
Okay, so I'm looking at this, and I want to buy these GDXJs so bad, because and I feel like I'm just sitting there, and I've our good friend Ronald Sturfley from Incrementum, he emailed me about like a month ago saying I'm at a conference in Switzerland for gold stocks and gold itself, and it is dead. Nobody likes it. Everyone hates it. And I was like, oh my God, that's the greatest kind of contrary signal that's ever been.
Yeah.
And since then, the thing's gone straight up. So I've been an idiot with this piece half written in my mind, ready to go, and I keep waiting for a pullback, and yet we don't get it. So now I'm sitting there, and I'm like, oh,
gold is making an all-time new high, and the juniors are still 20 some odd dollars.
They suck. I'm not disagreeing with you.
But no, the point I'm making is that you're not too late to get in.
I know.
Like, I mean, if gold breaks to new highs and people start getting frothed up about this trade, then this thing still's going up 50 or 100%.
That's right. But I'm just looking at this, and it's almost to the penny that this has worked. And I'm like, if I write this up right now, I bet you anything that this trend line holds and we get a move back down to 34.
But then just give yourself an out.
Yeah.
Say if.
But I'm just looking at this chart, and I'm like, Patrick, put aside what you think about the market and just give me pure technician. You would have to say that this is still in a downtrend.
Okay. but
Yeah.
one of the key characteristics of downtrends is the pattern of lower highs and lower lows. And at some point during a downtrend begins the transition to a bottoming formation, which is the base from which a new bull market begins. And often during those basing formations, it stops making lower lows and creates an accumulative base. And this could very well fit that, almost like a cup and handle kind of
I'm not disagreeing, but
pattern.
until it breaks that trend line, I'm saying that I should still respect the fact that it's still in a downtrend.
Yeah, but see the trade-off there.
Okay.
The trade-off there is the asymmetry of the trade, right? If you keep waiting, like it's like waiting for a golden cross or death cross when you're waiting for a 50 and a 200-day moving average to cross. It takes months for that signal to happen. By the time there is zero tactical benefit for you acting upon that signal. It's the most useless. And often it literally goes the opposite way once that signals, because it's been a trend that's been running for months. You wait too long, there's no asymmetry in the trade. You have to at some point take a risk that this is the breakout, and you have to use risk management rules that if it doesn't break out, you have to get out. But you can't just wait for a trend line break, because sometimes you're going to get a really bad fill and it ruins the whole trade.
Okay. Well, there you go. I thought it was interesting because it was literally to the penny. And as we did this, it's hitting at right up against that trend line. But the 3-year down trend line. I don't know. Anyways, let's do some no stupid questions.
All right. Lena, come save the day.
No stupid questions, but only stupid answers.
That's exactly right.
All right, first question here. Hi, Kevin, Patrick, and Lena. I love the show and really appreciate all the info. I've been listening for a couple of years now and think the addition of MH Plus is perfect. My broker is Questrade, and I have to make bond orders over the phone. An agent calls me after about 30 minutes to confirm the details. They quote a price, and they said that their spread is baked into the price. Am I supposed to negotiate the price? I've only used online brokers and never had to talk to a human to make a trade. Can you give me a sound clip of you're busting my balls here, that I can play over the phone? Thank you very much.
Kev, you want to
Okay, I'll take this one. Unfortunately, I think it's going to be very difficult for you to negotiate a price with a discount broker. And this is the problem with bonds, is that they actually, there's a lot of manual work involved, and they're actually just putting a spread on versus the institutional desk that they're buying it from. And if you were buying enough, you probably get a better price. But the reality is, if you're buying it on lot or like something that's less than, $500,000 or $1 million.
Bonds are over the counter.
Yeah.
Right. And this is not an exchange traded product. And you have to deal with the fact that you're dealing, it's no different than an ISDA account or anything. Like, you're dealing with someone else on the other side making you an offer, right?
It's even worse because it's retail, and it's, if you actually figure out the amount that they're making, it might not be that much, because there's a lot of, manual labor involved. So here's a couple ideas, things to try to think about. One, go see if you can find an ETF that holds your bonds that you want. So, for example, let's say you were wanting to buy a TIPS, or what's known as a real return bond fund in Canada. Yeah, you wouldn't get the exact maturity you want, but you could still go buy it in an ETF. And in an ETF form, the cost is basically zero. The bid offer is super tight. So if you were to go buy a TIP in Canada, and you actually went and asked a broker, you might get a bid offer that's $2 wide. So that's 2%. Meanwhile, if you go and look at the ETF, it's probably 0.2% or even 0.02% wide, the bid offer, and then the commission is a lot less. So if you can find an ETF, use the ETF. There's lots of target date funds, meaning that there'll be funds that invest with a certain date. They'll buy like 2028 bonds or 2029 bonds. So you can definitely figure that out. The other thing is that if you do want to trade specific issues, and unfortunately in Canada, you can't do it, there's no listed bonds. But if you go and open in an interactive broker's account, they'll actually put a lot of corporate issues on their system. So there is a way to go and trade individual individual bonds. But you need to go and you need to have an interactive broker's account as opposed to a Questrade account. Hope that helps.
There you go. All right, Selena, next question.
Next question. Hi, question for Patrick on crayons and squiggles. What's the convention for performing technical analysis on futures contracts? Do you look for areas of support or resistance on unadjusted charts and use roll-adjusted or continuous charts for trend lines, oscillator indicators, etc.? Apologies if this has been asked before. Avid listener from the UK. Thanks.
It's funny that we just had this conversation on gold, Kev? Well, I think you can take away a lot of information we had on that gold. I mean, the thing is that when futures contracts trade in contango, when you're looking at an individual month of expiration, then if you go far enough back, the price where it was trading a year ago wasn't the actual spot price, but rather all of the different carry costs that associated with the position had the price there a year ago. The continuous chart often reflects the best image of tracking spot prices. Obviously not perfect, but it is often one of the best ways, and it gives you the most consistent data. But obviously, the more something trades in backwardation or contango over long periods of time, the messier it makes the whole thing. I mean, predominantly the key is you want to make sure you're on the right side of trends. It doesn't, like, ultimately, if you're using an oscillator like a MACD or something, which if you're using the monthly contract versus you're looking at continuous, they're pretty much going to give you a crossover the exact same time. I think you're splitting hairs for overthinking it. Ultimately, you just need to have a contract that has enough good data for you to see where the major trend shifts are as you're trading. Yeah, you want to add to that?
No, it sounds
Kev,
good.
or?
I'll let you do all
All
the TA stuff.
Yeah. So next one, Lena.
Hi, Kev, Patrick, and Lena. Longtime listener, love the show. Got onto the show via Patrick's cheating with that other guy. Did I mention Doom?
Oh my goodness.
A quick question regarding the FANG's Mag 7. I wonder if we are all looking at these stocks in the wrong way. From what I see from most conversations around these stocks, the discussion seems to always focus on their absolute performance versus rest of market versus long bonds, etc., with the argument being that eventually they will shit the bed like everything else in the broader S&P. However, could the reason they are holding up have more to do with the fact that they are monopolies that have been allowed to consume any form of potential new competitors without any oversight, e.g. Facebook buying Instagram? Thinking about it, they have the balance sheets and scale that act as a moat in their respective markets. Not only that, but it is near impossible that any of them could be broken up given their scale, the fact they have been allowed to get so big and vertically integrate. Add to that the power of lobbying in U.S. politics, which can stop any change in its tracks. Maybe markets realize they are the nearest thing to a sure bet when everything else is going south. Thoughts?
You want me to take
All
this
right,
one?
Kev, I'm going to make a comment and then I'm going to let you take it. When a major trend is underway, those people that are in the trend will always find a reason why it's happening. So when Tesla's ripping to the upside, everyone's going to be driving an EV car and that's the future. When the agricultural stocks are running, everyone will say, well, everyone's got to eat. There always is some reason that they come up with to justify what the trend is. But the market always does what the market always does. It's all about flows. And when everyone gets too crowded into one trade, inevitably there will be a turn point and the trends mean revert. I'm not saying that has to be devastating or anything, but this idea that the Mag 7 or the FANGs keep running relentlessly and because of this they will never go down is nonsense. The markets are always correct. It's the way it's always been and always will be.
Well, I would agree with your sentiments, Patrick, but I would say that this listener is spot on correct about the reasons that it has performed so well. Listen, this is his arguments are completely valid. They keep chewing up other competitors. They have the best balance sheets.
Late stage capitalism.
Yeah, and listen, they are making tons and tons of money. Like there is just no doubt about it. You go look at their earnings. It's real money. So
yeah, no growth though.
It depends, but like you go look at the earnings growth, maybe not recently, like this last quarter, but if we look from a year ago, there's lots. The real question is, and this is to your point, Patrick, what are you paying for those? And then what are the chances that they'll be able to continue growing at that pace? And there's all sorts of examples throughout history. And like, let's just take the Nifty 50, where the stocks that were the most revered, the ones that were going to change the world, ended up doing exactly what people, the bulls, thought they would do. Yet, unfortunately, because there was so much growth priced into the price of the stock, the actual performance of the stock price was disappointing. And trading is all about figuring out what am I paying versus what what is likely to happen. And there does reach a point where you're overpaying for what that growth. Like take NVIDIA, what was it, 35 times sales or whatever? Like could it and like that's not times earnings, that's times sales. So yeah, could NVIDIA keep growing their earnings at this rate and grow into that 35 times sales? Maybe, but I doubt it. I think it's a bad bet to make. And I just think go back to Scott McNealy, the Sun Microsystems founder, that in 2000, he was very much in the same situation as the FANGs or the Mag 7 find themselves now. It was the darling stock of the 2000s. And in hindsight, he says to the market, he says, what were you guys thinking pricing me at 11 times sales? Think about this. 11 times sales means that even if I made 100% on my profits, even if I didn't have any costs of labor, if I didn't have any cost of making these things, even if I didn't have any rent and stuff like that, I'd still take 11 years to pay you back. And he stopped and he think, what were you guys thinking? Well, we're now at 35 times sales on big companies. Yeah. And ultimately I'm kind of in Patrick's camp in that yes, there is a good chance that these stocks are fabulous companies, but there's also a very good chance that the price of these stocks disappoint in the coming years.
You can apply Harley's statement where he says there's no bad bonds, just bad prices. In the same way, you could say there's none of these Mag 7s are bad stocks, just bad prices for them.
Right.
It's to kind of paraphrase that same thing. And ultimately, they're just going to come down to a level where inevitably they're going to be priced right. And that it's just when does that happen is why we get together on this every 2 weeks to shoot the shit about this, right?
You got it.
Anyway,
Lena,
help us out. Where can people submit their questions?
If you have any questions for Kevin and Patrick, please submit your questions to nostupidquestions@markethuddle.com.
All right.
Okay, Patrick, before we do the outro, why don't you tell people one last time where they can get their toaster?
Can we get an air fryer instead?
Yeah. Oh, the air fryers are nice. No, but listen, everyone, I'm just doing again a fun, not fun. I'm doing a webinar, basically just talking about put protection and how it's never been cheaper to insure the downside of your portfolio. And Kev, we talk about where these markets are so expensive, and if you're invested in a portfolio today and you are scared, you can either go to cash and sit on the sidelines earning interest, or you could stay invested and just remove the left tail risk of a market event. And so those of that want to stay invested, there's an opportunity to learn how to insure the downside risk of your portfolio and be able to continue to press the bull side of this market. And it's never been cheaper to do it. So you can join me on Monday, December 4th at 1 p.m. Eastern time for a webinar, and you can just register at bigpicturetrading.com.
All right. So thanks for tuning into the Market Huddle. We appreciate you spending time with us. Please give us a follow on X at the Market Huddle. You can listen to the Market Huddle on all the networks: Google Podcasts, Podbean, Spotify, Android Play, iTunes, and YouTube. By the way, Patrick, I saw a lot of my subscribers were posting in my chat that they were within the top X% of Spotify listeners to the Market Huddle. Like, how
really?
you have this end of the year thing. And I just wanted to let you know that I did mine, and I don't listen to us, obviously, because I listened to you already. And
but you do poke in to see how I'm cheating on you, right?
nope,
No.
that was nowhere to be found. The ladies won for me. My therapist ghosted me, and then actually I had Flirting with Models. No, Flirting with Models is a finance show. It's a terrific finance show. It's actually it's great. And
oh, not those kind of models.
No, it's a great name too. Like he just nailed the name. Like, anyways, listen. So Patrick, where can they find you? I'll just finish this up and put us out of our misery. Where can they find you, Patrick?
Bigpicturetrading.com and on Twitter at Patrick 𝗪𝗔𝗟. Where can they find you?
You can go check out my newsletter at themacrotourist.com. And listen, we can never have too many friends. Bear market, bull market, we're just happy to spend some time together on this crazy ride. Now stick around for the after show.
All right, so this beer,
Yeah.
it's good.
Oh, good.
It's good. The French know how to make good
It's
beers.
not the French. It's just, I think they probably just took it.
Where did you buy it?
I bought it in Nova Scotia.
East Coast?
Yeah.
The beer's from Quebec.
Oh, is it?
It is?
Yeah.
Are you sure
there
it's
you go.
me?
Yeah, no, it's definitely, it's from Quebec. Buckland.
Ah, la belle Provence.
Yes. And so the French, they get some bonus points here. It's a good beer.
Okay. Well, what you got to give us a rating.
It's I'm going to go high. I'm going to go 8.2.
Whoa.
Whoa,
He is.
Is that low?
well, that's pretty high for you, no?
Good for you.
Yeah, I nines are reserved for something special. But to give something in the eights, I think it's a good beer. This is I would recommend it if anyone has a chance to grab one. It's a great
The
beer.
reality
Worth
is
a
that
try.
nobody understood what Lena said when she pronounced it. So
Yeah,
nobody knows.
because I it's a travesty the way I
you
speak
go.
French.
Yeah.
So guys, first time in like a year and a half, I made it into a movie theater.
Oh, you did? What did you go see?
Napoleon.
Oh, how was it?
Great historical movie for being a historical thing, but it I don't know, it didn't seem to have a great flow. But I really am into these kind of war movies, so I was like really enjoying the kind of story in that regard. But I was thinking it was going to be a little more gladiator-like, and it was more like a history documentary, like
Reenactment kind of.
but it's just like it. I mean, yeah, there was a little bit of, they worked that love story a little bit, but overall it was just trying to kind of go through his life. Anyway, but first time in like a year and a half that I went to movie theaters, and I remind myself there why I only go 1.5 years.
Why?
Once
What didn't you like?
I don't know. I don't like.
Was it your date?
Yeah.
It was-
I went with Luke.
I know what it is. You went to a place where you weren't allowed to drink. And you was like, you went 3 hours or 2.5 hours without drinking. That it?
No, that wasn't it.
You actually drank.
That wasn't it. And you know what? Like out here, I couldn't believe it. In North America, when you go to the movie theater, when you go and grab your popcorn, drink, and everything else, you end up paying more for the food than you got for the ticket.
Yeah.
Right? Like you can easily spend $30-$40 on popcorn and drinks. Just it's ridiculous pricing. Like, so we went and like bought the water, popcorn, a bunch of the stuff like that. It was like 12 euros.
Oh, this is in
for
Portugal.
2 people. Yeah. And it was like, what the hell? Like I've never seen it so cheap in my life.
Yeah.
Like it was like.
Listen, they know how to. Everything's priced.
But they don't serve alcohol there, which is a big disappointment. Because in France you could get a glass of wine to go watch your movie, right? Like it's.
You just made me laugh because I'm surprised they don't serve alcohol in there. And I got to tell a quick story about my son. And I usually talk about my kids, but I'll talk just briefly about this because of Portugal. And maybe I've told you this before, but when he was in Portugal, we were out and we were going to a mall, and his mom and his sister were, going out and shopping, and we were looking for something to do. And we usually just find like a man seating area where we just kind of relax. But we couldn't find one. He's like, okay, let's go to McDonald's. And I go, come on, you're in Portugal. Like, you don't want to go to McDonald's. And he says, yeah, no, it'll be different. And I'll be like, no, how different can McDonald's be? And then you give him the credit card, he takes off. Okay. And I got to tell you, he's like 15 maybe at the time. Okay.
Oh.
He goes to McDonald's, comes back, and he says, and I said, see, it wasn't that different. He goes, no, look, I got this chicken mango salad, or not salad, sandwich, and I got a beer.
True.
It's
He
true.
literally, they served him a beer, and I was like, oh, God.
There's no such thing as being carded in Europe. Like, you know what?
But
Like, you could be 15, 16.
Yeah, and not only that, like he barely spoke the language. Like they had to speak English to him, and not only that, Patrick, it's like McDonald's. What are they doing serving beer at McDonald's?
No, every single food court place serves like Super Bock.
You can either get water or a beer for the same price.
Yeah, absolutely. It's for literally the same
Patrick,
price.
you've gone to the right place. Was that like, wait, did you just like when they were selling you on that? Did you just find that out? You're like, so stop right there. I'm in.
Did you say I did? Did you say I can have beer in the food court? Done. Sold.
All right,
That's
Lena,
funny.
you do anything fun and exciting while you're in Portugal?
Actually, no. I can't say that I have.
Nothing.
But I am back in Toronto now.
You're here
To
for
the,
Christmas.
Yes, but when I landed, it was just above 0 and flurries. I
But
wasn't
it's
very
nice
happy about
still.
it.
Nah, come on. This is nice.
God.
I still like this. It's
Oh,
February.
in Lisbon, it
when
was like
it's-
18 degrees. I was walking
I
around in
know,
a
but you
t-shirt. It was
don't-
so nice.
You wouldn't want that all the time.
18 degrees?
No.
Come on.
It's still really like I'd want down to 0. I like the winter. I just don't like the 4th month of it.
Yeah. Or like slushy snow outside.
Yeah, the slushy snow sucks. Like they're the first.
Well, there's nothing worse when you don't know which shoes to wear because you're going to get the slush. It's going to ruin everything.
Yeah, listen, I agree with that, but it's really just February that's bad. And March.
Actually,
April's not
I
that good.
prefer February over March and December.
Why?
Because that's when it's slushy and gross. It's like in February, there's snow on the ground. It's properly frozen. It feels like winter. At least if it's winter, it feels like winter.
Yeah.
It's kind of the transition moment sucks.
Yeah, March is pretty gross.
I don't.
I prefer the dead of winter than the wings.
Okay. All right, I'm gonna go back to work.
All right.
Since
All right.
you do this in the middle of the day.
All right.
Okay.
Have a good one, everyone.
Okay. Thanks, everyone.
Cheers.
Take
Go have
care.
a great weekend.
Bye-bye.
Thanks. Bye-bye.